Good Friday morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith, and here are three things you need to know this morning. Call it resilience or cognitive dissonance, but stocks keep going from strength to strength. The S&P 500 closed at August 2022 highs yesterday, now within a hair of 4,200. That, though, is the level at which Bank of America thinks you should think about hitting the sell button. The tech-heavy Nasdaq also extending its epic breakout, fueled in part by the fervor for any exposure to AI. A host of retail results this week painted a picture of a choosier consumer. It should have put maybe a dampener on things, but it didn't. A strong showing from the nation's biggest employer, Walmart, kept the tailwind blowing. Next week, we'll get Costco, Best Buy, and Dollar Tree all hitting the tape. Thing number two, another issue that investors seem to be brushing off. It's the debt-related spectacle unfolding in Washington. President Biden balancing the fast-approaching debt ceiling deadline day back home with geopolitical tensions abroad. Speaking from the G7 summit in Hiroshima, he called for momentum in what are now higher-level talks. The president confident that Congress will act in time. This is House Speaker Kevin McCarthy hints that a vote could happen next week. Participants at the summit in Japan will be aware of the consequences if the world's biggest economy was to default on its debt. Treasury Secretary Janet Yellen has called it devastating. And thing number three, Disney's feud with Florida Governor Ron DeSantis takes yet another turn. The entertainment giant pulling the plug on the construction of a $1 billion office complex in Orlando. That investment was expected to bring around 2,000 jobs from California to Florida with the incentive of a state tax credit. It is the latest development in a political feud between Disney and DeSantis, which began early last year with the signing of the so-called Don't Say Gay bill. CEO Bob Iger hinted at retaliation in last week's earnings call, asking if, quote, Florida wanted the firm to invest more and pay more taxes.
Well, it was a mixed picture for retail this earnings season as Walmart saw strong growth in its grocery category as consumers get more cautious about spending. And e-commerce sales, they jumped 26%, where Target saw online sales lag, with the digital comparable sales falling for the second straight quarter. So what does this tell us about the state of the U.S. consumer? Joining us now, we've got Simeon Hyman, who is the ProShares Global Investment Strategist, and Heather Herzog, who is the H² Research Chief Research Officer. Great to have you both here with us on this Friday morning to round out what has been off into the races, part of the retail sector earnings season here. You know, if we are to kind of summarize this in one word, Simeon, what would you annex to the retail earnings that came through this season?
It's not omni-channel yet. I was just looking this morning at ProShares, we have an online retail index and a separate brick and mortar index, so we split them. And if you look at earnings season so far, you got about half the retailers in so far. The online index has grown earnings 76% year over year. The brick and mortar index minus 1%. So we're not quite to the point where half of the Walmart square footage is last mile fulfillment with drones flying out of it.
Yeah, I mean, and Target even had a drop in its online sales, which is also pretty interesting here. He thought, what do you make of it, right? It has been really interesting to hear the likes of Targets and Walmart, for that matter, still point to people not buying electronics, not really buying apparel. It seems like things are really split right now.
I mean, that makes complete sense, though. If you walk into a store, the last thing you're probably going to do if you're watching your budget is make a big ticket purchase, right? You're going to focus on the essentials, the groceries. If you have to remodel your home or you want something new, you're going to buy something small. So people are really paring back on what they want to purchase and how they're spending that money. And also, I tell people how there was a real bifurcation on how people spent before the pandemic and then after. There was a lot more store traffic in the stores, and then the consumer just got used to spending time on their sofas, spending their money while shopping on their phone. They're scrolling. I always say that if my phone is across the room, that purchase is not going to get made. If I have to walk across the room, get the phone, and go ahead and make that purchase, it's not going to happen. So,
you know, I'm curious in the retailers that you're talking to, kind of what the sentiment is like. Walmart seemed to be in a better position, but even Target, in doing badly, is still sort of measured in its commentary. Is there fear out there among retailers? Like, how are they feeling?
I think the big box stores, what we're talking about now, I think right now we're seeing them feel a little bit more confident going into the next quarters and definitely in the next year. You saw Walmart raise their guidance, same thing with Target. Those retailers are realizing that because their concentration is so much on grocery and those essential items, and they're really just doubling down on that. I talked to one of the chief merchandising officers. Actually, I did a talk at Shop Talk with one of the team members of Walmart merchandising, and she was saying how Walmart really narrows down on the merchandising per local stores. So when you have that localization of merchandise, you tend to get a lot more traffic in the stores and people buying that more.
So just to follow on that really quickly, and would love to get both of your responses on this. Heath, first to you. Just anything about the consumer right now signal what we've been hearing from other CEOs this earnings season in a Q3 2023 recession?
So what we are seeing with the consumer right now is that they want to go out and shop. But what they are doing is making sure that the retailer is catering to them. So I was looking at the unified benchmark by Manhattan Associates. They were saying that the retailers that really focus in on things like fulfillment and making sure that the consumer is basically has this return policy on lockdown. They can sit there and return things very quickly and have that logistical side basically running like the turnkey. That is the retailers that are going to fare well. The consumer, like I said, is really getting very specific about where they want to shop. They want that holistic approach to shopping if they're going to spend their money. And so while I don't think the consumer is going to be spending, like they did pre-pandemic, I think they are going to be very, very careful about that. They're still feeling scared. I mean, there's still headwinds like inflation coming out. Even though we're seeing inflation decrease a little bit, they're still nervous.
Yeah, I was one of those consumers, of course, who has taken things home to check them out in my own mirror just to see how they look, and then probably return a few of those things. But same question to you, Simeon.
Yeah, I think the mixed results we're seeing from the retailers and consumer sort of tepid behavior is consistent with what we're seeing across the economy. That's pointing to the debate between a soft landing and stagflation light, I think, is almost a distinction without a meaningful difference. We only had 1% GDP growth in Q1. Suppose that goes to minus 0.5 or even minus 1. Is that really a big difference? And if inflation comes in at 2.75 and we don't declare victory, or it comes all the way down to 2%, I think we're in that realm of somewhere between a soft landing and a very mild recession, and I think the consumer's behaving just like that.
What's also interesting to me is as we look, there's the big macro picture and what this means to the economy. There's what it means for if I'm an investor and which retail stocks I might want to look at right now. I think the point you're making is really interesting because we've been talking about consumer discretion, consumer being choosy about what they're buying. I think your point is not only that, they're being choosy about where they're buying it because the stakes are so high right now for these retailers to execute pretty much perfectly. I mean, we see Bed Bath & Beyond obviously was not executing perfectly and paid the price.
Right.
So looking from what we've heard from thus far, looking ahead to specialty retailers reporting like the likes of a Gap or Macy's on the department store side, how do you think that's going to play out?
Well, it's interesting because in that unified benchmark, it was saying that department stores, we've had this sort of conversation around department stores. Anchor stores are starting to close down in malls. But the likes of Macy's have really looked at their metrics and saw what their consumer was doing, what their customer was doing, how they were trying to shop and what they wanted. Do I think the flagship Macy's really needs some help still? Yes. Do they have it perfect? No. But what they are really trying to do is marry that omni-channel, which I don't love that word, I'm sorry. I think that we need a new word for it. That's been around for almost 12 years now. But they want another, they want a fulfilled experience. And I know I keep talking about this returns aspect, but when you have the consumer buying things online, trying them on and sending them back, that is how the consumer shops. I was thinking about the statistic that I read the other day that a third of Americans under the age of 10 don't know what it's like to go into a store and shop. So, and that makes complete sense. Julie knows I have twin 4.5-year-olds. They don't know what that whole surprise and delight is like going into a store. Their surprise and delight comes from when the Amazon packages come to our home. So when retailers start understanding that that is the new consumer coming in, and they're starting to switch their buy, to switch their merchandising, to understand that surprise and delight comes in a box, that's when we're really going to start seeing traction, especially into the future.
That is a really good point as I think about it. Like, I remember many hours spent being dragged around with my parents at the mall.
Right.
Now, you don't need to do that because you just go online and buy. But the surprise and delight, I guess, is mitigated when you try it on in the mirror or it doesn't fit or whatever it is. And then you got to send it back.
Exactly. That's kind of a bummer.
That's so interesting, though, these kids who are going to be digitally native in terms of shopping.
Yeah. If you think about it, my daughters have been into a mall once. I grew up in a mall. This is why I do what I do, because I love the mall. But my daughters don't know what that experience is like, or they don't have that fulfillment from it.
Really interesting. Heatha, great to see you. Thanks for coming in.
Thanks
Heatha, an old
having
friend
me.
of mine, H Squared Research Chief Research Officer. Simeon is going to stick around as we talk about what's been going on in the markets. Stocks seem undeterred as of late, pushing higher despite lingering uncertainties from the Fed's June meeting to recession and the never-ending debt ceiling talks. Then there's the debate over the health of corporate America more widely. S&P 500 companies have delivered a healthy amount of beats, but accusations of corporate sandbagging or lowering expectations just to surpass them, that's also been a theme. That's a theme for a long time. Let's get back to Simeon Hyman, ProShares Global Investment Strategist. So it has been interesting. I mean, we've sort of been range bound for a while, but then recently did seem to have a little bit of breakout to the upside. I was looking at some of the stats from the October lows. A lot of it's been about tech. Industrials and materials have also done okay, but we've had this big upsurge. Is it a justified surge?
Well, we likely don't have too much room left. So I think from our perspective, what we've been thinking about is first, you start with the bond market. And what we see in the bond market since the beginning of the banking thing, whatever we want to call the banking thing, we've had this rally in treasuries. Of note, it's all been a decline in inflation expectations. So that's good. That means that the contractionary banking thing is probably just enough to bring down inflation, but not a deep recession. What that means is that it does likely suggest that multiples are probably range bound. And if you scatter plot PE multiples against a 3.5 to 4% 10-year, you get 18 to 20. And we were at 18, we're at 19 now, so 20 would be 5-point-something% away in terms of multiple expansion, which then leaves it up to earnings, which, as we know, have been bleeding low single-digit declines for the S&P 500 for several quarters now.
And so with that in mind, in terms of the forecasts that have come through over the course of this earnings season, is there set to be any type of rebound from what we're expecting that would make valuations either attractive or make them kind of make them actually worth investors' attention right now?
Well, they're fairly valued. Again, 18 to 20 is an appropriate range. So if you're looking at earnings now, there isn't much of a sign that earnings growth is going to be any particularly better than what we've been seeing. Forecasted earnings growth 23 over 2022, consensus is flat. So if we're coming in -2, -3%, that's not too far off from flat. So you do have to think about where are there pockets in the market where there's some companies who are growing earnings. Tech is a maybe, but of course the valuations are rich. If you're looking for companies that are growing earnings that aren't that expensive, our ETF ticker NOBL, which we talk a lot about, tracks the S&P 500 dividend aristocrats. The PE is about 20% discount to the market, and for the last 3 quarters, they've been expanding margins and growing earnings because they're consistent dividend growers. So it's going to be a muted environment, I think, for the rest of the year.
So this is now leading me to look up how the Russell Value versus the Russell Growth has done. I mean, value has not, because when I think about dividend aristocrats, I think, and what the themes that you're talking about, I tend to think of value over growth, but as we know, growth has been outperforming. So as we get to that sort of top potential, if you will, of the S&P 500, do you think we'll start to see that shift back into value? Are we already seeing it?
Well, I think there's a challenge here. So first, if you look at the dividend growth stocks, they're really in the middle of the style box because that word growth is in there.
Right.
They're kind of garpy. And the challenge here is if you go to that value side and you're not getting enough growth of whatever it may be, earnings, cash flow, dividends, then if you buy a stock that's not growing anything, then you actually bought a bond. So that's what I think is the challenge on the value side of the equation.
All right. Simeon is going to stick with us for just a little bit longer here this morning. We've got a few more conversations to have here, but we got to switch gears as 3 is a magic number. So we're bringing you 3 major Disney headlines to end the week. First up, Bob Iger making good on a threat to pull business out of Florida amid an ongoing battle with Governor Ron DeSantis. Disney waving its magic wand and going poof on a $1 billion office complex, which would have brought more than 2,000 jobs to the state, according to the Florida Department of Economic Opportunity. Headline 2 for Disney. Disney's ramping up plans to sell ESPN as a subscription streaming service. According to a report from the Wall Street Journal there, the project, codenamed Flagship, would make its ESPN offering its own streaming service, which could appeal to cord cutters who still want their dose of sports. According to the plan, ESPN would still exist as a cable channel. And last up, Disney is starting to remove certain shows and specials from Disney Plus and Hulu, according to Deadline. This comes as the streamers increasingly look to cut costs amid a renewed focus on profitability. We'll say goodbye to dozens of shows on May 26th. Shares of DIS, with all this news, they are moving lower pre-market by about 0.6%.
Well, there does seem to be gradual, small progress in debt ceiling discussions. This is the deadline for a deal. The so-called X-date fast approaches. However, we have been here many times before. Since 1960, the debt limit has been raised over 70 times, though after decades of the same old story, could it be time to bring the debt ceiling into the modern age and make a change? Yeah, I think we all agree on that one. Here to discuss is Maya McGinnis, president of the Committee for Responsible Federal Budget, and still with us is Simeon Hyman, ProShares Global Investment Strategist. Maya, I think nobody likes the thing, right? But the difficulty is how to change it and what that would look like. As someone who favors discipline on spending, does it make sense to divorce the idea of the debt ceiling from these periodic spending negotiations?
Yeah, it clearly does. I mean, the problem right now is that we have a budget process that is beyond broken. We don't even put a budget in place most years. It's been 20 years since we've passed a budget on time through Congress. And so the debt ceiling becomes the default place where deals can be made. And in past years and decades, it's actually been something that's been part of a lot of constructive deals where savings or budget process reforms were put in place. It's worth noting that under President Trump, the 3 times they lifted the debt ceiling, they actually did the reverse. They included policies that made the debt worse. But generally, the debt ceiling has been something that can bring along improvements, but the risks are just too high, and they've been getting higher over the years. So the question now is, can we reform and replace the debt ceiling with something that will actually limit the amount of borrowing? Because it's lawmakers who are passing all the bills that are increasing our borrowing. So limit the amount of borrowing, but not limit our ability to pay the bills once we have already put the laws in place, which is absolutely a backwards way to control borrowing.
And so with the borrowing controls, so much of a focus as well, kind of more long term, what is the economic correlation there? If there is less borrowing and more of a focus on responsible spending, what does that do economically from the projections that the committee is really looking through here?
Yeah, so the fiscal situation that we have where our debt is growing faster than our economy, it's about to reach the record we've ever had, including eclipsing where we were right after World War II. Our interest payments are going to run us $10.5 trillion over the next decade. We'll be spending more on them than we do on children, on Medicaid, or on defense, all of which are worrying metrics. Clearly, getting the debt situation under control will improve our overall fiscal situation. The way it does so is it helps your long-term economic growth and standard of living. It leaves your interest payments in the budget not squeezing out other areas of the budget, including important investments. It helps strengthen your role abroad because right now it's a national security risk. And it leaves us more prepared for the next emergency that we have, whether it's a recession or a pandemic, which is when you really do need to borrow. We borrowed so much during COVID, and that was the right thing to do. So it's important to get that fiscal situation under control, basically to remove so many of the vulnerabilities that plague us both domestically in our economy, but also globally in terms of our role in the world. And that's why this is not the right place to have these battles, but these battles are really important. We can't keep borrowing at this rate that we have, which is really jeopardizing so many things about the strength of our country.
Yeah, I'm thinking about what happens after this is resolved, because the odds are extremely high that it's resolved. And what's sticking in my mind is we've been talking a little bit about inflation. And right now we've got a one-year break-even inflation that has come down all the way to 2%. And a very quiet driver of that has actually been, for the first time since we've been keeping these records since 1960, M2, the money supply, has shrunk. So on the other side, once there's resolution, if that allows the money supply to expand a little bit, we might have a little bit more lingering inflation than is baked into the markets right now, which is baked in at least a smidgen of concern about the debt ceiling debate.
Well, it depends on how this deal plays out. So if they actually generate real savings, clearly fiscal policy for the past years has been pushing in the wrong direction on inflation. The American Rescue Plan helped create inflation in the first place. And then because we borrowed trillions of dollars once inflation was already there, while the heavy lifting, of course, falls to the Fed, fiscal policy was pushing in the wrong direction. If we bring some level of consolidation, particularly in the short run over the next 2 years where there may be discretionary caps, that will help bring inflation down a little bit. But none of it is going to do the heavy lifting. And here's what actually I think needs to happen, either as part of this deal or after the deal. They probably should put in place a commission that would look at three things. One, how to deal with kind of the triple threat we're in the midst of right now: controlling inflation, avoiding a recession, and stopping any contagion in the banking sector. Two, coming up with further savings vehicles, mainly on the main drivers of our growth: Social Security, Medicare, and taxes. And three, they should reform that debt ceiling so that we replace it with a mechanism that's much better at controlling our actual borrowing. A commission is probably the best way to do this because these things are politically hard. Our politicians don't get along particularly well, in case anybody's noticed. And they need some kind of cover to do the real heavy work of dealing with our economy, our fiscal situation, and how to avoid additional debt ceiling showdowns in the future.
Maya, is a commission politically realistic? I mean, as you say, coming to some sort of outright agreement on some of these issues does seem to be unrealistic in this environment. Do you think there is enough agreement to even get a commission together to work on some of these things?
You know, I think a commission is realistic because a commission allows lawmakers, most of whom understand that these hard things have to be done. They know that just cutting taxes and increasing spending, which is what voters like, isn't good for the long run health of the economy, but they don't want to tackle it. That's why they're making so many reckless promises on Social Security and Medicare. Instead of pointing out that those programs are headed towards insolvency, they're promising not to touch them, but they know that that's not workable. So I do think getting a commission in place is absolutely doable. The hard lift, the heavy lift will be once they actually get the commission there. Probably they could come up with recommendations, we'll see, but actually getting them adopted in Congress has proved difficult in the past. So I don't say a commission is a sure thing. I say it's the best option we have at really dealing with the underlying structural imbalances that we have and that are only getting larger over time.
Well, we shall see if even they can get that together. Maya McGinnis, Committee for Responsible Federal Budget, president of that organization. Thank you, Maya. Good to catch up with you.
Thank you.
We have breaking news this morning in the banking sector. Morgan Stanley CEO James Gorman said he is stepping down from the leadership within the next year. Gorman making the announcement at Morgan Stanley's annual shareholder meeting this morning. The battle to become his replacement is on. Gorman says Morgan Stanley's board has identified 3 possible candidates for the role. He's going to stay on as executive chairman for a time after the new CEO takes over. Gorman's been CEO since 2010. That makes him one of the longest running U.S. bank CEOs. He is, by the way, 64 years old. But this to me raises, I mean, this is a bit of a surprise, I think, but and Simeon, I want to bring you into this as well. If you think about the heads of the largest banks in the U.S., you think about a Jamie Dimon, think about a Brian Moynihan, like a lot of these guys, Jane Fraser is newer in her role, but a lot of these guys have been there for a long time. So you wonder when we are going to see a more wholesale rollover within that sector.
I mean, Jamie Dimon was at the head of JP Morgan when I was interning there back in college, way back when. But yeah, the transition plans that we're looking at here, and we had even had a couple years back a major transition and even a fighting for the top role at Goldman Sachs as well, which netted in David Solomon being selected for that position. But again, this is someone who's been there since 2010.
The benches are deep. We know the benches are deep. And so The biggest challenge in a transition is, of that deep bench, who do you have to lose when somebody wins? Sure. So to me, that's more of an issue than the ability to pick someone who's going to be a great steward. It's if you lose a couple of people who lose out in that race and go to a private equity firm or whatever, how do you make sure that the bench of the bench is there to step in?
Yeah, that's a really good point. Well, we're going to keep watching that. Morgan Stanley shares not a huge amount of change in those on this announcement. Coming up, Deere joins the long list of S&P 500 companies beating the street this earnings season. But so what? We're going to take a look under the hood at the bigger story next.
Let's get to some individual movers this morning. We have to start on Foot Locker, starting off Friday on the wrong foot. Shares sinking after the company slashed its guidance for the year as it struggles with declining sales. It now sees them falling 6.5% to 8% on an annual basis. And as we continue to look through some of these numbers here, you're taking a look at the shares moving lower by 24% here pre-market. There's a few things worth calling out here. Number one, this is a company that had laid out their lace-out strategy. We brought that to your attention when they had announced that in about a quarter past here. But they did mention their sales have since softened meaningfully since announcing that at their investor day in March. And they're citing a tough macroeconomic backdrop causing them to reduce the guidance for the year as they take more aggressive markdowns. Not good. That means they're going to be discounting more, trying to drive demand, manage inventory, get through some of the inventory that they do have. And I've been in a Foot Locker on about a weekly basis at this point. There's a lot of inventory in there. And on some of the SKUs that people might not necessarily gravitate towards the same way that they would a drop that's taking place on one of the other D2C or direct type of apps from the major manufacturers out there. The only other thing that I'll really call out here too is the square footage. The square footage needs to come down drastically. You think about the way that this company, as well as other retailers, are engaging with the consumer, and even the stat that Heath was mentioning a moment ago, Foot Locker is a mall-heavy brand, always has been. And so that annexation of where the consumer has been able to access them for so long just means that that number needs to continue to come down more, and they're guiding for it to come down by about 4%, that square footage.
There's one more really important thing to talk about here, and that is the new CEO, Mary Dillon, who just took over in September. And just looking at the analyst chatter around the implications of this negative report for her, some of the analysts saying this really does not get her era off on the right foot. That's according to an analyst over at Wedbush. At the same time, the analysts there saying we don't view this as an indictment of CEO Mary Dillon. It's too early in her tenure for her to have made meaningful changes in the business. So that said, it's not like people are cutting them a break if you look at how the shares are trading this morning. So this really puts the pressure on her to deliver going forward and improve things as she gets further into her tenure there. And then we had the opening bell on Wall Street. Let's do a quick check of the market, sponsored by FlexShares as we get underway here. It's been a higher week for the markets overall, and it looks like that they're going to add at least a little bit to the gains today. The Dow, the S&P, and the Nasdaq all, the Nasdaq now just opening up about a fifth of 1%. I do want to offer one caveat for today. It's a witching day, folks, and there's some estimates that there's going to be a lot of derivatives contracts, futures and options contracts expiring today. That does tend to cause some volatility, particularly at the open and at the close. So the numbers you see here, don't get too attached to them. They're probably going to change maybe more than they usually do.
Let's savor the moment for right now. It's early in this Friday. Let's play the tunes. Let's play the jams here. Pump up this jam. Right now, we are higher on the Dow Jones Industrial Average, but as Julie said, perhaps don't get accustomed to seeing that in the green on the day. We are up by about 0.1% right now. We'll see if we hold on to that. The Nasdaq Composite, though, over the past 4 days, it's having a pretty good week, actually. It's up by about 2.8% past 4 days. And over the course of today's early trading activity, you're seeing that higher by about 0.1%. S&P 500, that too, past 4 days looking good. Net higher, 1.7%. And then here for today, we're up by about 0.2%. Let's take a look at the 11 S&P 500 sectors here out of the gate this morning. And we'll just pull that up for you here right now. 11 sectors. We've got them loaded up here on the Wi-Fi Interactive for you. Consumer discretionary pulling up the caboose. And yeah, it's because some of those discretionary dollars over the course of this week, it's been illuminated, through some of the earnings reports that the consumer is being even more discretionary about where those dollars are going. And so as you're seeing, consumer discretionary actually down 0.5% here this morning. Let's take a look at the past 5 days just to see how it's been doing. Okay, so not too bad. It's still higher over the past 5 days by about 2.8% here. But leading the pack here today, you've got energy. About 10 out of 11 S&P 500 sectors in positive territory. We'll see if we hold on to that. And let's take a look at the tech-heavy Nasdaq Composite here. You've got Apple up by about 0.5%. Google also seeing some fractional gains here. A little bit of a decline, slip up out of the gate from Microsoft. That's down by about 0.3%. And then additionally, you've got Tesla up 0.4%. I want to take a look at some semiconductors to tee up our next conversation here, as well as semiconductor stocks are largely mixed here on the day, but taking a look at the largest decliner as of right now, it's Applied Materials by about 1.7%. So we'll come back to that in a hot second. I didn't realize we were doing this other one first.
Yeah, we're doing it right now.
Yeah.
It's down 1.7%. It could be a lot better. It could be a lot worse. The quarter seemed a little mixed here, so let's talk about it. Why don't we skip to Applied Materials, since we're talking about that right now. The company coming out, it looks like with earnings per share that did beat estimates, and it looks like its forecast might be looking a little more at least in line with what analysts have been predicting. The share's down perhaps because of concern over the memory business in particular. That seems to be what's weighing here. Analysts kind of mixed here. The analysts over at Citi saying the beat was driven by continued strength in the Internet of Things, communications, automotive, power, and sensors. But as we go through the year, we're still going to see weakness in memory. And that's something that we've heard from the likes of Micron, for example, as well. Yeah, and continued weakness in PCs and smartphones, key factor for memory customers there as they have significantly reduced their investments in 2023. Some of the interesting kind of inflections that they mentioned as well here that are driving innovation, they've released more than 20 major new products since they formed their
ICAPS group about 4 years ago, and you're probably going to hear a little bit more about that. But this is really a kind of a clear trend they're calling towards regionalization of supply chains. And so that's interesting to hear about, just in the kind of manufacturing and the capacity that they're looking to bring online even more so, but still a call that started out with really laying out the challenging macro that they're seeing and how that's impacting the semiconductor industry, at least in the near term. Some negative, but also some positive as well, given the number of inclinations we've heard on conference calls to talk about, okay, where the chips that they're producing can play a role in even the generative AI landscape and the thrust of investment that we've seen there too.
Right. And then finally, in the movers, let's get to what Brian Sozzi likes to call the Julie trade, tractors, because I like to talk about agriculture. John Deere is what we're talking about, reporting a 36% rise in second quarter profit. Strong sales of its tractors and agricultural equipment gave the company a boost in the latest quarter. It also raised its forecast for the rest of the year, and those shares are up about 4%. I mean, look no further than some of the grains prices that we have seen, some of which have wavered a little bit, but still many of which are higher than we have seen in recent years. There's also the idea that some of the supply chain issues that were hurting Deere's manufacturing and supply capacity over the course of the pandemic and beyond, that those are now normalizing in more decided fashion. So that's helping matters as well.
Yeah, large ag really going to be one of the kind of drivers over the course of fiscal 2023. The company looking for that to move higher, up roughly 10%. So that particularly worth tracking going forward. And then additionally, you might see some gains in Europe as well. They said that's going to be flat to up 5%. But there's a lot of other areas that still have kind of an industry outlook, looking at flat and moderately lower as well. So, you know, it's not all roses in terms of what they are seeing, or green pastures, I guess. I don't know. But at the end of the day, I think for some of the different segments that we're going to be tracking as well, the price realization and the net sales that they're looking for, net sales for precision and ag up by about 20%. That could continue to be kind of the outsized boom for this business, at least over the next year, or fiscal year 2023. A few notes out this morning as well. We got a note from Bank of America's Michael Hartnett. He says that tech and artificial intelligence are forming a bubble, and Fed rate hikes may not be over, with rising bond yields posing a risk. Simeon, you've been sticking around with us. I want to get your thoughts on this as well. We've heard so many mentions over the course of the earnings season about AI. It's been kind of this magical potion, if you will. But is that just brewing a bubble that we are waiting to burst at some point?
Look, tech's been on the rebound. Part of it's AI. Part of it is simply that, of course, tech was down substantially last year. But I don't think the tech side of the equation has that much to do with interest rates. Again, the duration is such a funny thing in stocks. But if you're looking on a valuation basis, you have to say that the technology sector is very market cap heavy, and that's a challenging way to consider investing when there are other opportunities that aren't nearly as expensive.
Yeah, and as we talked about, maybe some of those in dividend and other areas. You know, ironically, one of the hot areas that has not been hot in a long time this year has been things like dividend growth, things like bonds in particular as well. The bond market has been very popular. At the same time, as we try to game out what the Fed is going to do, there's really sharp divergences right now in both, not only how different strategists view it, but how different parts of the market view what the Fed is going to do. You know, there's now even a scenario where the Fed could skip raising rates at its next meeting and then raise at the one following that. Like, what are we seeing in the markets, and who's right in all of this?
I always just look at the market and see what it's saying, because that's the poll right there. And earlier this morning we were talking about break-even inflation, and it's down to 2%, not just at 10-year break-evens or 5-year break-evens. Break-even inflation for 1 and 2 year is come down to 2%. That's where the rally came from. That's pretty cool. Now, if you're thinking about how to construct a bond portfolio right now, look, you got to have a little extra shorter duration stuff because we don't know when the Fed's going to cut. But 4% plus in the 1 and 2 year space, you know you're going to have to reinvest it, but you got to take advantage of some of that. there is, I think, a risk that the longer end does start to rise or at least not fall. So in other words, ultimately some sort of steepening. And that's a challenge to just taking long duration bets. Here's an interesting space though. Credit looks pretty reasonable. IG spreads are at about 145 basis points. That's long-term average. The thing that a lot of people get wrong, leverage isn't high right now. Leverage is really low. Net debt to EBITDA for the S&P 500 is 1 time. It's 3 times on average. So there's a real opportunity there, but you got to go long to get it. And so there, go ahead.
I'm just going to ask you, like, I think one of the issues is particularly we're talking mostly to an audience of retail investors, right? You start talking about credit, like, people are like, what do I even do with that, right? I think it's just traditionally not seen as accessible. Stocks, I understand. Bonds, I understand. Investing in company debt is just this whole other thing, and we have seen people go Treasury Direct, for example, which is very accessible. In other words, this very long-winded way of me asking you, how do people get into credit right now? What's the best way? Is it through ETFs?
It's actually pretty straightforward. There are lots of ETFs that give you easy access to the credit market. We take an interesting take at ProShares, which takes advantage of an interesting opportunity right now. So for us, a way to get exposure to investment grade credit would be our ETF IGHG. What's different about it is it gives you exposure to bonds, but it hedges the interest rate risk. So you get all that spread, all that attractiveness from having long duration, long-term credit exposure, but you're hedging out the interest rate risk. Here's why it's extra interesting right now. The curve is inverted. The Treasury curve is inverted. You're going to make money on that hedge instead of spending money on it. That's pretty cool. So I snuck in a little extra juice here, but the easy answer is you access credit through ETFs is a great way to do it. We've got a little extra twist on it in this environment. That's pretty cool.
The other thing I'm curious about is when you look at flows this year, you've seen some outflows from equity funds. The biggest surge has been into money market funds, right? Where you have the advantage of getting a little bit of a rate, you have the advantage of liquidity. How long does that continue, that enthusiasm for the sort of the shortest term instruments?
It can't go much longer. You mentioned Treasury Direct. We all bought it last year, and we got our 7, 8, 9%, and now that's cut down to 4%. A normal world, a normal Treasury world would have Fed funds at 2% and the 10-year at 4%. So the idea that you can get 5% in money markets is you have reinvestment risk, but that may go on for 6 to 12 months. Now, remember time in the market versus timing the market. It makes no sense to have all your money in money markets because you don't know when the equity market's going to take off. It's already done better than people expected this year. The worst thing you could have did at the bottom of the great financial crisis was to go to cash. You would have never gotten your money back. So yes, in the context of your bond allocation, sure, have extra shorter stuff for a little while, but don't take your mix of stocks and bonds. Don't take all that stocks and put it in money markets. The chance of missing out on a bond market rally, on an equity market rally, are just too big.
ProShares global investment strategist joining us here for the 9 a.m. hour. Thanks so much for joining us on this Friday. Simeon Hyman taking the time to break down a range of topics for us before the weekend. Appreciate it. And coming up, everyone, Disney's feud with Florida Governor Ron DeSantis takes yet another turn. The entertainment giant pulling the plug on construction of a billion-dollar office complex in Orlando. All of the details next. Welcome back, everyone. Let's check in on the latest market moves. To kick this off and this trading session, let's go to the New York Stock Exchange, where Yahoo Finance contributor Remy Blair is standing by. Hey, Remy.
Good morning. Well, Wall Street has had yet another positive open this morning, and this does come on the heels of 2 straight sessions of gains. Given the advance that we saw in the major stock averages, the Nasdaq and S&P 500 hit their highest levels for the close for this year. As for today's session, the latest earnings reports as well as Fed speak continue to be in the spotlight. As for market-moving stocks that we're watching here at the New York Stock Exchange, let's start out with a look at Occidental Petroleum. Now, shares of the company have advanced in New York morning trade, and this comes on the heels of news that Berkshire Hathaway has scooped up more stock of the energy company, purchasing approximately $200 million, raising its total stake to a whopping $12.7 billion. Now, Buffett's conglomerate controls over 20% of Occidental stock. Also, another stock that we're watching this morning on the heels of the latest earnings report out from retailers is Farfetch Limited. As of this morning at the open, we saw shares pop a whopping 20%, and this means that the company's stock has come off recent lows. The luxury online retailer reported first quarter revenue that was up 8% year on year, and its bottom line fell less than forecast as consumers kept shopping, at least with the luxury retailer. Now, boosting numbers for the company, they did see an improvement in inventory in the latest quarter, as well as successful brand partnerships and stronger in-store sales, contributing to that strong quarterly result. Now, it is possible that when it comes to discretionary spending, at least in the luxury space, consumers continue to spend. Very recently, in terms of other earnings coming out from the luxury sector, we saw LVMH, Moet Hennessy, Louis Vuitton, and Richemont report Q1 performance that did top expectations. Here in the U.S., as we look ahead to the end of the month, we will continue to get earnings out from retailers, including Lowe's as well as Nordstrom.
Thanks, Remy. Looking forward to all those numbers coming next week. Let's turn to another corporate story we're watching. Disney scrapping plans to build its nearly $1 billion office complex in Florida. It announced the news of its canceled plans on Thursday, citing, quote, new leadership and changing business conditions. Wonder what that could mean. This comes as the company is also openly feuding with the state's governor, Ron DeSantis. Joining us now is Ali Knau to discuss this more. So this is really kind of heating up, right? It sort of felt it had gotten quiet, but this is not going away.
It's not going away. Now, Disney didn't specifically say that Governor DeSantis was the reason for these plans, but you can surmise that the ongoing feud had something to do with it. In an internal memo obtained by Yahoo Finance, Josh D'Amaro, who chairs the Parks, Experience, and Product Division, told employees that the company would be stopping the construction of this employee campus in the Lake Nona region of Florida. Now, along with that construction stoppage, that also means plans to relocate 2,000 California-based Disney employees are no longer. Now, it's a shame because a lot of those employees did end up leaving the company because they didn't want to relocate. Now these plans are just going all over the place. The relocation plans, they were first announced in July 2021 under the leadership of then CEO Bob Chapek. The campus was supposed to open between 2022, 2023. That was then delayed to 2026, and now we got the news that it's just not happening. Now, the Office of the Governor did eventually respond to me for comment on this. They said that Disney announced the possibility of a Lake Nona campus nearly 2 years ago. Nothing ever came of the project, and the state was unsure whether it would come to fruition. Given the company's financial straits, failing market cap, and declining stock price, it is unsurprising that they would restructure their business operations and cancel unsuccessful ventures. So fighting words there from the Office of the Governor as they are in the midst of feuding complaints and lawsuits, and the drama continues.
Yeah, absolutely. So for investors trying to make sense of multiple headlines that surround Disney on a daily basis, there's also the ESPN announcement too. What is the way to look at how Disney is kind of moving these parts around, whether it be in where the employees are going to be at or where certain assets that they've already said are going to be kind of their own standalone internal entity are now looking at being offered to the public as well?
Well, I think from an investor perspective, these fights with the governor, that's not really moving the stock too much. We took a look at the stock yesterday. It was relatively flat. Now today, it's down on the day, down about 2% right now. And, we've heard from analysts, McGuire out with a new note this morning, downgrading Disney shares from outperform to neutral, seeing those near-term uncertainties as a risk for Disney's future. Now that includes those linear networks deteriorating. You mentioned ESPN. There was a Wall Street Journal report that there are talks about moving ESPN fully over the top. That's something we've heard from Bob Iger. We don't know what the timeline could be on that, but that's another question mark for investors. So I think it's more of these fundamental issues of the company. If we were to see this fight with the governor materially impact the parks business or Walt Disney World specifically and their earnings, I think that's something that could move the stock. But in terms of this fight in particular, that's one element here that I think shareholders are shrugging off, at least for now. That's not to say down the line it couldn't be, more impactful to Disney's bottom line.
Yeah, I'm just saying now, actually, Macquarie has downgraded the stock this morning. So maybe that is also helping push things down. That has to do with all of these uncertainties that are ongoing. It doesn't seem to have to do with what's going on in Florida,
right?
To your point. But even still, some other stuff. There's plenty for it to contend with, I guess, is what I'm saying. Even if you exempt all of the Florida stuff here.
Exactly. And Disney, look, they're in the midst of restructuring their business. They're in the midst of trying to pare down on their content as well. They're going to take a content impairment charge of $1.5 to $1.8 billion as they look to scrap certain series and specials from both Disney Plus and Hulu. That's something they announced on their latest earnings call. And again, this is something that we're seeing across the board as a lot of these media giants are really trying to grapple with profitability and be number one in the streaming wars while also making money. So it's that push and pull. How do we create value for both our shareholders as well as our customers?
Let's be real. Can we talk about the real reason that Disney is struggling right now? It's because the investors are thinking about the fact that the Sixers are no longer in the playoffs right now. That's going to impact the NBA viewership. Clearly, advertising dollars. That's the real reason.
-2, at least.
-2.
I know that was
-2 viewers.
That was a
-2.
dagger. That was
Yeah.
a dagger. And like Josh Schaefer, our business reporter, he's a Celtics fan. So,
Josh has got to go home.
I know. So I think there's a lot of internal competition within Yahoo Finance as well as Disney.
You keep bringing this up, man.
I'm hurt.
I think you want the sympathy of the people. I think that's.
You know
Listen,
what?
we got the Eagles.
Here's the thing. We're going to have Kenny Smith on later on today. Of course, former NBA player and now analyst for NBA on TNT. I'm going to ask him why the Sixers lost, because I want some.
And
I do want some
Embiid getting
sympathy.
MVP.
You want some sympathy. You want some answers. Accountability.
Yeah.
Okay.
I want answers.
Really.
Okay.
This is the serious stuff we got to talk about,
Okay. Well,
I'm just hurt.
you guys can talk about that. I'm going to tell people what we're going to talk about on air next. Coming up, we're going to take a look at some movers on this witching Friday. $1.7 billion worth of derivatives are expiring. Could we see some wild swings into the close? We'll have more on that next. let's bring you a check on the markets. Not even 30 minutes into the session, but wanted to zero in on some specific stuff here. First of all, I'm looking at the regional banks here. We've got a little more green than red on the screen in today's session. But what's interesting to me is that we continue to see a rebound in some of these really beat up names. Here's the weekly chart for PacWest Bancorp, now up by about 35%. I wanted to take it back and look at that 2-month view about since we got the collapse of Silicon Valley Bank, right? So here's the 2-month chart, still down about 34%. But coming up off of the bottom here is what we have seen more recently. And I want to find Western Alliance and we'll take a look at a similar chart there. There's the 2-month chart for Western Alliance. It's a little bit more bumpy here, not down nearly as much since the initiation of the banking crisis. It looks like down about 12.5%, but still seeing that bounce in particular over the past week in which it has gained by 28%. Remember, it talked about getting a new influx of deposits earlier in the week. So that helping matters. Also, of course, this week marked those hearings that we saw on Capitol Hill on the part of regulators and some of these bank CEOs that have run into trouble. So it's been an interesting one in that sense. And then looking at banks more broadly here, the big banks, as we saw some of the bank execs also go to Washington to talk about the debt ceiling. Looking in today's session, and I am looking for Morgan Stanley, which is right down here on the news that the company says James Gorman, its longtime CEO, is going to be stepping down within the next year. They are talking about who's going to be the successor. Today, it's down about 0.5%. 5 days, it is up about 2%, and year to date hasn't done much of anything, Brad.
All right, big news there out of the banking sector this morning. Coming up, everyone, a big change is coming at one of Wall Street's big 5 investment banks. We're going to talk further about succession and how deep the bench really is. That's next. Good morning, everyone. Happy top of the 10 a.m. hour here. Welcome back to Yahoo Finance. I'm Brad Smith here with Julie Hyman. Taking a look at the markets here this morning. U.S. major averages higher across the board. Fractional gains for right now for the Dow, the S&P 500, and the Nasdaq. The S&P 500 on a percentage basis leading the way up 0.3%, and on a point basis, you're seeing the Dow higher by about 50 points right now. Well, despite concerns around a looming debt ceiling deadline, recession fears remain on the minds of consumers. And the timing might not be ideal here for President Biden. Yahoo Finance's Rick Newman joins us now for this week's Bidenomics here. Okay, Rick, take us in.
We talked all week about what's happening with the debt ceiling. I tried to get away from that and look at something else that caught my eye this week, which is what's happening with excess savings. This is something like $2.1 trillion that Americans saved during the COVID pandemic for a couple of reasons. Number one, they just weren't going out and spending money while everyone was locked down. And then stimulus payments helped beef up some bank accounts. So about 3/4 of that has been spent. There's about $500 billion left in that excess savings. And there's some new research from the Federal Reserve Bank of San Francisco saying they think that money's going to be spent by the end of this year or the very beginning of 2024. And I think that's important because this has served as a really important crutch for people. Inflation has taken more of the family budget. So where are people getting the money? They're getting a lot of that money from excess savings. Just look at what people are paying for cars. $48,000 is the average cost of a new car. You'd think people would be saying, no way, there's no way I'm paying that much. People are paying. They have the money. So what's going to happen when that excess savings is gone? This could be the recession cushion that kind of disappears by the end of this year. Of course, we've had many predictions of a recession. There are still many predictions of a recession. So if that excess savings is one of the things that contributes to a recession once it's gone, timing is bad for President Biden because that would mean recession around the first half of 2024, just as the election is heating up. So something he needs to pay attention to.
And as we were just looking at that chart, it looks like it takes time, quite a bit of time, following recessions for people to build up those excess savings again. Of course, the difference is in 2020 when people were getting payments from the government.
Yeah, and this actually gets to everything the government did to combat the COVID recession. It was more than $5 trillion worth of stimulus money. That is more than double the amount of stimulus money the government put into the economy during the Great Recession in 2008 and 2009. And I think it's going to be a great question for economists and economic historians. Was that the right move? Because we obviously had a lot of inflation that came after that, and probably all that stimulus money contributed to inflation. So kind of an academic question here was whether the government went too far. And I think there's an interesting case that the very last stimulus bill, which was the American Rescue Plan, that is the one President Biden pushed for and ultimately got Democrats to pass in March of 2021. That may have been unnecessary. That may have been one stimulus package too many, but the money's there. And we're going to, it's still boosting spending through the end of this year. So let's see what happens when that extra money is gone.
Thanks, Rick. Appreciate it. And luckily, we have somebody right now who can opine on all of these issues about a recession, about the effects of stimulus. Our next guest, though, says we should be using a different word than recession to describe the current state or even the near future state of the U.S. economy. And that word is resilient. Joe Brusuelas, RSM chief economist, is with us now. Listen, I am curious for your view on what Rick was just talking about, but let's get into this resilience versus recession discussion first, Joe. So it sounds to me like you don't think a recession is indeed around the corner.
Well, we're not in one now, and our model says the first chance that we would fall into one would be early next year. So I would agree in general with what Rick said. The $5 trillion put on the table was the first time the federal government's really used fiscal firepower in a significant way to alter the dynamics and trajectory of the American economy since the mid-1960s. Yeah, we got some inflation out of that, but I would argue most of the inflation we got was due to the supply chain shocks followed by the Russian war in Ukraine, in addition to the demand where we had too many dollars chasing too few goods. That $500 billion that we have sitting in excess savings right now, that's really the difference between an economy that's growing right around trend, at around 1.8%, an economy that would be in recession. You know, if you take a look at the corporate sector, what do you see? Significant pullbacks on business fixed investment, that's productivity enhancing goods, but it's the consumption that's really driving things.
But Joe, I'm sorry to interrupt, but what about what Rick was just saying about that new research that shows that excess savings is perhaps more quickly being spent down than is being factored in?
Without a doubt. I mean, we've gone from $2 trillion to $500 billion in a little over a year and a half. So it is being spent down. I think the real question is when we get to the end of the year, say CPI is around 3% and nominal wage growth around 4%. Well, you know what's going to happen is we're going to see spending continue to go forward because you got a 1% increase in real wages. At that point, you've got a very different set of dynamics and a very different discussion. Yes, those of us who work in and around financial services and financial markets will be inflation's above the target. We need to get back to target. But the best research, as you might know, is that once inflation is moving between 3 and 4%, consumers really don't care. It's more about financial markets. So this discussion will be dynamic and evolve as we go forward.
So as of right now, it doesn't seem like the economy is in a recession. I mean, you could easily look to employment and say that it's not. But at the same time, what are the metrics that you would be looking across to determine whether or not, NBER aside, to best determine if we are actively seeing signs of that?
All right, so if I'm stranded on a desert island in the South Pacific, and let's say I'm bored and I want to think about economics, finance, and the condition of the United States, the one metric that I would go to would be the 13-week moving average of initial claims. Right now, that tells us, yes, there's a little bit of an increase in layoffs, but we know that within 8 weeks, people are finding jobs. That's the median duration of unemployment. So we are nowhere near a recession right now, despite a very sour set of sentiment inside corporate America. And of course, the social and political polarization we have in the country, which really makes me not look at a lot of soft data these days, because I know they're just answering based on their preferences around the tribe.
Let's speak a little bit more about politics, though, and about tribe, because I am also curious to get your take, Joe, on something else Rick was just talking about, which is whether, especially that last piece of stimulus, did more harm than good, and how the repercussions perhaps are still being felt. What do you think?
You don't get that last piece of stimulus, we're probably in recession.
Mm-hmm. So I guess you do think it was necessary.
I do think it was necessary. Look, we're still dealing with, and will for years be dealing with, the shocks unleashed by the pandemic. We're 2.5 million workers short right now. You know, Julie, in the United States, it's hard for us even to have a discussion around why that is. Most of us have a good idea that it's the long tail of COVID, and it's knocked a lot of people 55 and older out of the workforce. Yet, because the social and political dynamics make that conversation very difficult, right? So when I see $500 billion on the table, that's going to get us through the last vestiges of the inflation shock and the interest rate shock. I think when we get on the other side of this, we're going to have a very different discussion, because right now it's difficult to talk about, right? Inflation is sitting at 4.9% if you use the CPI metric. It's going to be down to 3% by the end of the year. Then we're going to have some discussions around what's the appropriate Federal and Federal Reserve inflation target. Do we want to shoot for a different level of growth? And do we need that churn because we have all those baby boomers retiring? We're going to have to finance their Social Security and their Medicare. It's a very different discussion from the one we're having now. But one would think in 2024 and 2025, that's going to be one of the primary narratives around our economy.
Considering that we've been talking about recession for the better part of a year now, and we've continued to try not to fight the Fed, at least in the equity markets, but to best anticipate what they're going to do, what do you believe of the Fed credibility once we get through, or I guess we have to get to the next recession that has been impending and that we've been discussing for this length of time?
Well, there's going to be a period of time where the Fed's going to need to rebuild eroded credibility. What that means is they're going to have to move back to risk management and a focus on price stability. Look, price stability is a precondition of maximum sustainable employment. The Fed needs to not throw in the towel on that. While I think it appropriate that they pause at the June meeting and give it 2 or 3 months to assess the lagged impact of past rate hikes and notice the risk matrix around us, tightening lending by local and regional banks, and of course the debt ceiling. It's a good time to stop, but doesn't mean that it's permanent. Now, this is where a lot of the noise is going to be in financial markets, I think, this summer of will the Fed restart after that June pause? Look, if inflation's sticky, if we don't get the relief we're expecting inside the housing sector on rents, owner's equivalent rent, shelter, Fed's going to need to restart those rate hikes, and I would expect 1 or 2 more if that's the case. If we do get those big year-ago base effects, and it looks like we're getting down to 3 or even below 3 on CPI, and we're sitting at 3.5 to 4 on core PCE, well, then I think maybe conditions are right. The Fed will stop. That'll be the peak. And then watch, you'll see equity markets take off.
What do you think that places the real, then, at the end of this terminal rate at?
Well, I'm thinking that the geopolitical tensions around the world that are resulting in reshoring of work back to more friendly countries, back to North America, it will entail higher costs and require a higher interest rate. And instead of being 0.5% on the real rate, we're probably talking about 1 to 1.5%. So we're going through some structural change. It's very hard to identify in real time while you're in the foxhole, but I think that that's what's happening. That's one of the reasons why I'm in that camp, that when we get to 3% on the core PCE, we need to have an in-depth, full-throated, robust discussion on the appropriate interest rate target. And I think 3% makes a lot of sense, because in order to get to 2%, we'd have to put just too many people out of work. To be honest with you, it can cause real problems, because right now we don't have enough people to fill the jobs. Female labor force participation rate, 25 to 54, hit an all-time high at 77.5%. And that's well below the near 90% of the male cohorts. But I think that's the last bastion of people we can tap to pull back in the workforce, which entails another discussion around incentives, structural flexibility among private sector firms, and perhaps childcare financed in an international way. And these are big, big topics, but the conditions are changing rapidly, and we're going to have to evolve with them.
Joe, one more really quick point to go back to the idea that we might get a skip instead of a pause in the rate increases. Yes. How disruptive would that be for the markets? How much has it been historically when the Fed seems like it's stopping and then does another one on a delay?
Well, we're in Shakespeare's undiscovered country here, aren't we, Julie? This is a very different type of inflation. So I don't think there's any real precedent. We will all draw on the lessons of the stop-start monetary policy of the 1970s into the 1980s and say that was a bad idea. But is that the best analogy for where we're at now? And I don't think so. Again, I think it's appropriate that the Fed pause. We're going to hear from Jay Powell in a few minutes. He's going to sound a lot like he did in his presser following the last FOMC meeting. But my sense is we're going to get some good news on June 14th when the Fed releases its forecast. I guess my sense is they're going to upgrade the forecast for this year, so it won't look like an inflation is imminent. Then we can have a much more nuanced discussion around the evolution of the path of monetary policy. And indeed, the Fed may need to pull back on its quantitative tightening program, because after we get through the debt ceiling, Treasury's going to have to flood the market with money. And you're going to want to watch the repo market as the canary in the coal mine around some near-term disruptions once we get through the artificial political crisis that's been induced.
Joe, thank you so much. Really interesting stuff to keep a watch on, including, thank you for the reminder, we are going to be hearing from Jay Powell as well as former Fed Chair Ben Bernanke in the next hour. Joe Brusuelas, RSM Chief Economist, thank you. Appreciate it. And let's take a look at one trending ticker that we are watching. Shares of Grab holding or rebounding today after sinking double digits yesterday on slowing delivery sales that fell 9% in the quarter. The company CFO said that despite that, he expects the second half of the year to be stronger for the delivery business. Coming up, why GM's slow development of its battery plants could affect its EV production goal. We've got the details next. Let's do a quick check of the market sponsored by Flex Shares. All three major averages slightly higher on this Friday. As we talked about, it's witching day. We could see the expiration of futures and options contracts causing a little bit of volatility. It's been an up week for the major averages that has pushed the S&P 500 to its highest since August of last year. Today, it's up about a third, 1%. Let's turn to autos now. GM is revving up its EV operations with the upcoming launch of its Chevy Silverado EV. And the company's out with some fresh details on the truck's capabilities. Yahoo Finance's Prasubramanian joins us now with the details. So what do we know?
Some upgraded figures for the new Silverado EV work truck. This is the fleet model that they're going to sell to commercial customers. They're upgrading on the top end the range to 450 miles, which is about 100 miles more than the nearest competitor, which would be the Rivian or the F-150 Lightning with the extended battery packs. So that's a big deal there for these fleet commercial operators. GM says that there's going to be another 350-mile range truck coming out as well, and then also a entry-level work truck that they haven't said the range yet, but pricing-wise, that entry-level one's going to start around $42,000, and then $75,000 for the mid-level, and $79,500 for the higher end 450-mile range. So that's a big deal for GM for that in terms of a work truck. And these commercial operators want more range as opposed to niceties like a touchscreen, air suspension, things like that. So this is kind of a big deal. And I think GM, for their part, is saying this is the better value proposition for our fleet customers.
Touchscreen still nice to have, but maybe in the future.
Yeah, I mean, these are the littlest touchscreen, not a 17-inch.
Exactly, not a full dash touchscreen.
Yeah.
And a new report is saying GM's EV production goal may take a hit from battery plant setbacks. So what can you tell us there?
So, we had the good news with the Silverado, but then also a little bit of skepticism here from Reuters. They're working with a company called Auto Forecast Solutions, which is a big data firm that watches what happens at the factory level. And they claim that, so GM says they want to make about 1 million EV run rate by 2025. AFS and Reuters says it might be around 600,000 because of the ramp up of their 3 battery factories. They're in a staggered sort of order, and they don't think it's possible to have enough materials or enough supply to make 1 million. So with that report, GM says we're standing by our targets. We're going to hit that 1 million EV run rate by 2025. So something to watch here as we see these battery plants come online and see how much sort of yield or rate they're going to get out of it.
Just quickly, is lithium the choke point for all this stuff? I mean, we know that's been a challenge for all of the EV makers. Or is there other stuff in building the batteries that is also going to be challenging for them to ramp?
Materials are always a problem, but in this specific report, they talked about how they just don't have the actual batteries, the plants up yet in order to make everything. They question whether they can actually make 1 million batteries by that 2025 deadline. So, but there's always a materials issue. Did you secure enough forward contracts to get your lithium and to get your nickel and to get your cobalt and all those sorts of things? So that's always a thing to watch.
Yeah.
Great reporting, great context. Yahoo Finance's own Prasubramanian, thanks so much. Also, everyone, coming up, the debt ceiling deadline looms large over Washington. Will a deal be made before June 1st? That's been the big question. That's next. Morgan Stanley's James Gorman is stepping down as CEO within the year. Gorman making the announcement at the bank's annual shareholder meeting this morning. He will stay on as executive chairman for a time after the new CEO takes over. For more on this, we turn to Semaphore finance reporter Bradley Sachs. From one Bradley to another, welcome. Good morning to you. Happy Friday. So let's dive into this. I mean, we didn't expect this. This wasn't on our bingo card when we started off this Friday. So now the search that ensues, who do we expect them to ultimately look to within their ranks that they have right now?
Yeah. And it's not totally unexpected. He's made a few comments over the years about, I think in 2021, he said, I'll be around for maybe another 3 years, but definitely not 5. So while, today wasn't necessarily circled on anyone's calendars, the idea that he's stepping down in this time frame isn't completely out of the blue. As far as who comes next, there's some, I think there's 3 obvious clear contenders that have been outlined by Morgan Stanley already. You have Ted Pick, Andy Saperstein, Dan Simkowski. My big takeaway always of Morgan Stanley is how they've transformed the business since 2009, 2010. The Smith Barney acquisition after the financial crisis, turning wealth management into a powerhouse and a very reliable source of revenue. Unlike trading, it just kind of churns out money every year. And from that standpoint, Andy Saperstein runs that unit. They made pretty big acquisitions with Eaton Vance and E-Trade over the years. So he's obviously a huge contender. Ted Pick as well. And you have this trio, and they've kind of been the core 3 since Jonathan Prezan left earlier this year.
And speaking of just executives at the big banks generally, I mean, whenever I hear about something like this happening, my brain turns to Jamie Dimon or even a Brian Moynihan, who don't seem to be imminently departing, but really are also institutions in and of themselves at this point at these banks. And maybe even more so than a Gorman stepping down will create some pretty big cultural changes. But is that something we should even be watching for at this point?
Anytime any long-term leader like James Gorman is set to leave, I think that's something you have to keep in mind. I don't think anyone has the reputation like a Jamie Dimon, and I think we saw that during the regional banking crisis. Morgan Stanley, like I said, has been building up a deep bench for this moment, and Gorman's talked about it. Where I don't think the culture of Morgan Stanley is necessarily something that's leaving with Gorman. That said, all the banks have obviously been building up benches, but Dimon's always the first one that comes to mind because of his profile, and he consistently keeps talking about, I'm just going to say 5 years when someone asks me when I'm going to retire. So I don't think Gorman has the kind of profile globally, nationally, like beyond people in the finance world like Dimon does. So I can imagine the culture of Morgan Stanley remaining pretty intact with whoever comes next. Will
there be a hallmark that people look back to Gorman's career and remember most notably?
Yeah, and so going back, I think to the wealth management point I made. When we've written about Morgan Stanley, the kind of consistent ethos we've heard from our sources, from analysts, is that it became a little boring, but in a good way. It's become a very, very stable earnings machine thanks to the wealth management, investment management businesses. It was not necessarily a sexy business 20 years ago, but the Smith Barney acquisition following the financial crisis has turned the wirehouse business, these advisors talking to high net worth people, into just a consistent double-digit returns franchise that I think if 20 years ago you said Morgan Stanley, this well-known investment bank known for deal making, was kind of riding along with its wealth management, leading the pack, you'd be surprised. But I think that's going to be his legacy, is that he turned this bank into a very stable, dominant player in a field where it had always been a player in, but has become a leader.
Switching gears, Brad, I want to turn to what's going on in Washington. And, we've been talking about ad nauseum the debt ceiling and the fact that markets as of yet, especially equity markets, have not really been reacting. What do you think sort of out there amongst regular Americans and investors they need to be watching when it comes to all of this?
Yeah, we reported earlier this week, and then I was at an investor conference on Wednesday, and the lack of concern from players in the stock market is a little shocking. But at a certain point, politicians in Washington, from a stock investor point of view, have been the boy who cried wolf a little too much. We've seen this game play out, and we haven't defaulted yet. So, what's the concern now? Why am I going to go running into gold and Bitcoin just yet? From an individual investor standpoint, it's a very precarious time for anyone investing because these talks seem to be going down to the last minute. But in the intermediate, if you're looking for like a judge of like how scared some professional investors are, the bond market, as we reported earlier this week, is terrified. The yields that you can get for something that matures on May 30th or May 30 or the end of May versus June 1st is, the gap there is huge because people are concerned that the government's not going to be able to pay its bills come June 1st. So anyone, thinking about investing as a, individual stock investor across the country has to keep that in mind, that while all the professional stock investors may not be very scared of this, the people who are known to be the gloomy set, the bond investors, the credit investors, are scared.
How does this impact the U.S.'s global standing?
Yeah, this is something that a few sources, the lobbyists, the strategists that work kind of as intermediaries between the banks and the politicians and the investors and the politicians have brought up a lot, is that beyond if we default or not, this doesn't look good from a global standpoint, from a global leader standpoint for the United States. And one point that I heard several people bring up that they're hoping more people from the finance side would start pushing is this affects how we're perceived as far as competing with China. China wants to move certain trade deals away from the U.S. dollar. This, all the circus in D.C. around the debt ceiling hurts the U.S. dollar's global standing as the reserve currency. If both parties are serious about combating whatever they see as the threat from China, this is a very clear way to strengthen our global position. And I think as one of the few bipartisan issues, that could be a sticking point for some people to get around signing off on a deal that they maybe don't love on other aspects.
Right. Bradley Sachs breaking down all things debt ceiling as well as some bank transition to come at the CEO level. Bradley, we appreciate the time this morning. Have a great weekend.
Thank you so much.
Absolutely. Coming up, everyone, business and basketball. We'll speak with former two-time NBA champion Kenny Smith on his new memoir. That's coming up. From the boardroom to the basketball court, former two-time NBA champion Kenny Smith's new memoir, Talk of Champions, does a deeper dive into the people who have shaped his life and what he's learned along the way. He joins us now. The champ is here. Kenny Smith, thanks so much for taking some time with us this morning.
Thanks for having me.
Absolutely. Let's dive right in here. I want to know, in terms of the transferable leadership skills from the basketball court even into the boardroom, what really sticks out from what you've learned along the way?
Well, I think overall, when I always read a lot of self-help books. Let's start there. And then I realized that, it's really from one person's perspective. So when I wrote the book, I also thought that this could be a great self-help book because every chapter is great people that I've met and what I've learned from them. So you now have 15 self-help books with inside. So when you say, wow, you know what, I do something, and I realize, wow, Bill Russell does that, is a chapter after him. Michael Jordan does that. Magic Johnson does that. Charles Barkley, Shaq. So for me, it was just more about making sure that, all of these things are transferable in terms of leadership qualities. The same things that you need to lead your boardroom is the same thing that happens and qualities that happens in young men early because you're leading 12 or 15 people in your locker room or decisively somewhere else.
Athletes, current and former, are now diversifying where their time is spent, including investments into business ventures. What do you look for in the leadership qualities from some of the very companies and the heads of those companies that you choose to partner with even?
Well, interestingly enough, I wrote a chapter about this. I've had some interesting people sleep on my couch. And one of them is David Kohler from the Kohler family, who is arguably in the plumbing industry, the best in the world. And, we were in college in 2018 and we're sitting on my couch and we're talking about all of the things that we would ascend. And one of the things that he said, well, Kenny, when I start with the company, I'm going to start as a plumber. I said, what? Your dad owns a company. How are you going to start as a plumber? He said, well, I'm going to start as a plumber because if there's something that happens and they say, hey, these screws are worth this amount, I'm going to know what that is as a leader of the company. I said, wow, that's the same thing I do in sports. He said, what do you mean? I know every person's role on the team, from the center to the coaches, the assistant coaches. So it's always knowing the gravity of what happens inside of your organization. And so at 17 and 18, I realized that big business and sports pay parallel in what was going on.
I think that's the headline right there, and that Kohler was sleeping on your couch before the business came to be what it is in an internationally known entity that it is right now. That's really interesting. Even as we think about some of the different ways that your career has progressed, going from basketball and on court now to being an analyst. I mean, how has, from your perspective, the game, the players evolved even in how they spend their time off the court?
Well, I think the game is involved in many ways because before, I think players were looking to invest in businesses, or most of the time, early on in our careers, were trying to figure out how to manage certain things. Now they are the business. And, there are very few businesses that can say, well, we were profitable $50 million this year. There are very few businesses in the world that could say that. So as an individual, when you have someone who says, I was profitable for $50 million or more this year, they are the business. And it's how to attain themselves and continue that. And then what to invest in a profitable business instead of a business that's trying to be a startup.
Absolutely. I wonder how much of the talk, because we see the talk that's on there. You're talking about, of course, right now, the playoffs leading up to the championship and the NBA finals as well. But, off studio, are you guys talking about your business investments? I mean, we have spoken with CEOs of some of the companies that we know. Shaq has served on the board of directors at. We were just talking to Papa John's last week or a couple weeks back. How often are you guys feeding each other just information about your own kind of investment strategy or the businesses that you are looking to work with?
Yeah, I think you hit it right on the head with Shaq. Most people see me pushing him in a Christmas tree and say, "Man, that was so funny." But I think for overall, we have all the time business conversations, and I wrote this in the book about how Shaq and we were having a conversation, and I said, "Shaq, do you feel like at times you're oversaturating yourself? You have a lot of commercials, you're overplay." He says, "Well, Kenny, I'm not in not the NBA anymore. There's a certain window of opportunity that's going to be available and open for me." And I said, "Yeah, but what about all your endorsements?" He stopped me right there. He said, "No, I never look at them as endorsements, Kenny. I look at them as partnerships. So our partnerships, then I'm going to do for them certain things that I wouldn't do for other people, and vice versa. And in those partnerships, we learn certain things." He also has what he says, "I have a Shaq Summit where all of my partners come together and then they learn about each other." So right then, my business acumen picked up years ago. And from that point on, I became a better businessman.
That's amazing. I mean, look, move over Warren Buffett's annual shareholder meeting and introduce now Shaq Summit, where perhaps that will get some more of the coverage here on an investment and kind of business profile basis as well. And you guys have an amazing team over there. Of course, people see that day in, day out, night in, night out with Ernie, Charles, yourself, Shaq as well. I'll give a shout out to Slice, who's like a brother to me. Even as you think about this next wave of where NBA content is consumed, how it's consumed, and how viewers are able to engage with it. What is the sports storytelling in streaming that you would like to see be more emphasized?
Well, I think right now, again, that there are very few people in the world. Elon Musk, let's say, is a billionaire. However, he's also, if you separately, he's the face of the company. Each individual, LeBron James, that's in the playoffs now, Joker from Denver, you have Jimmy Butler from the Miami Heat. They're the faces of multi-billion-dollar companies. So what they do affects every aspect of the company. And so on and off the court, which most people don't realize when they say, "Oh, this guy should be able to do this or do that," not realizing and never have been the face of a multi-billion-dollar organization. Then you think of a guy like Joel Embiid, who won the MVP. Now he's the face of the NBA, a $1 trillion organization. So very few people realize that these young men are faces of multi-billion-dollar and trillion-dollar companies, and they have to act and move accordingly because everything they do on and off the court affects the bottom line for the whole business, not just them as an individual. They think that it's, their playing time, their thing. No, it's multi and trillion-dollar industries that are being affected by every move that they make.
How can players that are trying to get to the league make sure that they are capitalizing on the business of their name, their image, their likeness, even before they step foot on an NBA or a professional level court, knowing that, careers can take wild turns at the end of the day. And we got a fresh new talent and prospect, Wemby, that's coming in, who's got a ton of fanfare around him right now.
Well, Wemby has an ability because he's the first global superstar initially. Like most players come in and are known, like LeBron James, he was known 100% here in America. Wemby's known worldwide first. And that is a unique position. So Wembanyama has an unbelievable access to, people in France and in Europe that LeBron James had to grow and get. So his ability is going to be much different. I think coming in, you've already been a leader of men and young men in your life. So I think that if you realize that you continue that attribute, those are the same qualities that CEOs look for. I have an AAU team at one time. I was coaching a 5th grade team, and the mom is screaming at me. She's like, "My son should be playing more." I'm like, "Well, I'm not going to talk basketball with you. I'm not going to argue basketball. However, your son, I put in charge of getting the team ready to play, the stretch, on the layup line, what to do. And every time that John says one thing, 12 other kids move. Do you want me to take that quality away from them, which CEOs of every company want, so I could give them 3 extra minutes on a basketball court? Or do you want them to have the qualities that could actually own a basketball team? He said, Kenny, I'm sorry.
It puts things in perspective a little bit more there. Kenny, we got to leave things there on the day and look forward to seeing more of your coverage this NBA postseason leading up to the finals. Kenny Smith, TNT's Inside the NBA analyst. Thanks so much.
Thanks for having me.
Absolutely. Guys, coming up, this week's retail results painted a picture of a choosier consumer. Next week, Costco, Best Buy, Dollar Tree, they're stepping up to the plate. We'll bring you more from our conversation with the nation's biggest employer next.
Walmart beat on the top and bottom line and lifted its full-year guidance in the latest quarter. The company saw strength in the grocery segment, offsetting a weaker performance in apparel and electronics. We spoke with Walmart CFO John David Rainey.
We had a really strong quarter. We're pleased that revenue, our top line, was able to grow over 7%. But I think very importantly, we saw that our operating income grew at 17%. And what this demonstrates is that the value proposition, our value proposition, is really resonating with customers. But we continue to see, as you noted, a mix shift in our business. As consumer wallets are stretched more thinly, they're shifting more of their dollars to purchasing items like food and consumables and less away from general merchandise. And overall, that does have an impact on our business because general merchandise tends to be higher margin for us. But even despite that, we were able to grow operating income in the quarter 17% and increased our guidance for the year as well.
John David, Brian here. Good to get some time with you. You mentioned on the analyst call this morning that sales moderated as the quarter progressed. Why do you think that was the case? And then bigger picture, how financially stressed is the core U.S. shopper at Walmart?
Yeah, the moderation did occur in the quarter, and there's a couple reasons, Brian, to point to. I think one is just headline inflation rates are coming down. That affects our revenue numbers as well. We're beginning to lap some of those periods of higher inflation last year. But there were also a couple key trends in the quarter that affected our business and the macro economy at large. And so one of those I'd point to is SNAP benefits. Those abated during the quarter, and that we tend to see that spending patterns follow that as well. We also saw overall for the quarter a reduction in year-over-year tax refunds. And the way that played out in the quarter, earlier in the quarter, we were seeing increases in year-over-year tax refunds For the quarter in total, it was down 10 or 11%. And again, spending trends followed that. And then lastly, and this was a good guy for us, but we saw an increase related to the cost of living adjustment with Social Security. And that happened earlier in the quarter. And so all these things combined kind of impacted the cadence of revenue growth in the quarter. And so February started off really strong, and then we saw a little bit of a drop down in March and April.
John David, Brad here. Would love to know in terms of the digital and the e-commerce business, and you've invested so much into that over the past 7 to 10 years, and it's really paying off here over time. I'm just wondering, as you think about further investment into that technological touch point with your end consumer, how you're seeing some of the members of your rewards program or those that are kind of closest to Walmart as a subscriber base, how they're continuing to engage with the brand and where they're even continuing to spend on an average basis, if there's any figures that kind of have been elucidated over that time in the investment in technology.
Sure. Well, our e-commerce business was up 26% in the quarter, and I feel like we're really hitting our stride here. Our value proposition is resonating, but it's not just around price. It's also around convenience, and that matters irrespective of what your income level is. And so things like online pickup and delivery continue to grow at much faster rates than the rest of our business. And when you have value like that, when we provide value like that to our customers, you're willing to subscribe to a membership where you have the utility in that. And what we see among those members is that about 50% of them actually come from the channel of online pickup and delivery. And the spending related to that they are appreciably higher than what an average Walmart customer is. So we want more people to avail themselves of the suite of benefits that we provide for our customers.
John David, how concerned are you that you guys mentioned on the earnings release, still seeing double-digit food inflation? Now, we have gotten a series of rate hikes over the past year and a half. Supply chains have improved, but we're still hearing from Walmart double-digit inflation. What's causing this, and any relief in sight?
Sure. Well, our guidance for the year really has sort of finally balances a cautious outlook on the consumer with some conviction in our own ability to execute on our strategy. But you're exactly right. If you look at the headline numbers, sure, inflation is coming down because we're lapping higher prices last year. But if you're a consumer going to buy a basket of groceries, prices are still high. If you look at food prices on a 2-year stack basis, they're still up 20%. And so pocketbooks are pinched, and that's causing customers to be more discretionary with these larger ticket items like electronics, TVs, home, and apparel.
You said on the call that you are seeing signs of stress on consumers below the surface. Is that the kind of thing that you're talking about? What else can you tell us about those signs of stress?
Yeah, it's the same thing that we saw in the prior couple quarters as well. When consumers are coming to our stores, we're seeing trade downs in terms of buying less expensive meats, or instead of buying a pack of 12, they're buying a pack of 6. You can see that their wallets are being stretched more thinly. And when you look broadly, I look at the same economic data that you do, but there are other indicators. We're seeing credit as a funding instrument, as an example, be more elevated to where it was in prior periods. You're seeing delinquency rates on credit cards in general tick up. And so there are these signs that there's some fraying in terms of the consumer health, and we're keeping a cautious outlook on that. There's a lot that we don't know about the back half of the year, and we want to be prepared for any type of economic environment.
Let's do a quick check of the market sponsored by Flex Shares. We are mixed right now, moving off of all major averages being in positive territory. The Nasdaq right now flat just barely to the downside. And just like that, with the flip of a switch, it's back in positive territory. Looks like we've got some hyper oscillation on the table here, hyper waffle, if you will. The Dow and the S&P 500, though, holding on to gains by about a fraction of a percent.
Hyper waffle. We've got some great interviews lined up all day here at Yahoo Finance. The big quit is over, making room for the big stay. Diane King Hall is going to speak with ADP's Neil Richardson on why workers are deciding to stay put.
Plus, how brands can leverage consumer behavior and stay ahead of major trends. Diane's going to speak with the chairman of Garret V. You know the name. That's coming up, and that's going to be an exciting conversation, no doubt.
And stay tuned for our 3 to 5 p.m. show. Shauna Smith and Akiko Fujita will speak with the CEO of Tanger Outlets after a big week for retail. That should be an interesting conversation. Diane King Hall indeed has you for the next hour of trading. Everybody, have a great weekend. We'll be back on Monday.
Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Diane King Hall. Here's what I'm watching. No stopping the rally. The S&P 500 now sits above 4,200's key level. That's the level at which Bank of America, though, thinks you should think about hitting the sell button. So should you get out? We ask our strategists about looming risks in this hour. Approaching the X date, President Biden balances the debt ceiling deadline with geopolitical tensions abroad. He calls for momentum, but could a vote in the House really happen next week? We'll dive into that story. And this week's retail results painted a picture of a choosier consumer. Next week, Costco, Best Buy, and Dollar Tree step up to the plate, among others. We'll discuss the nation's biggest employer and where the consumer goes next. But first, let's do a check on where the major indices are on this last trading day of the week. You're seeing some gains there, a little bit there, just above the flat line there. So investors looking to end the week, I guess, a little bit on the positive side. Let's do a quick check of treasuries. We saw the yield on the 10-year inching a little bit higher earlier in the session. All right, now, meanwhile, after a streak of Fed rate hikes, analysts are expecting a pause at the June meeting. Markets are currently pricing about 50 basis points of rate cuts before the end of 2023. However, a recent Bank of America report suggests there's a wedge between market pricing and expectations. Here with the details on that is Yahoo Finance's Julie Hyman.
Hello, Diane. So I'm looking right now at the CME Fed Watch tool, which is one of my favorites, to see what markets are pricing in for the June meeting. Right now, there's a 64% chance that there will be no change and about a 36% chance that there will be an increase at that meeting. If you take it till the end of the year, as you mentioned, people are pricing in a cut before the end of the year. And this is something that's been hotly debated recently, right? Indeed we're going to see a cut. Might we see a cut next year? The Bank of America note basically says markets tend to be wrong on both sides, that they tend to overestimate how many either hikes or cuts there are going. Basically, they have trouble gaming it out. And so if you look at their research here, there you're seeing where the market is pricing it, where Bank of America thinks the path will be, and also the consensus of economists surveyed by Bloomberg. So the market right now has rates lower than where Bank of America thinks they will be, and then where economists think they will be. And so we keep having this sort of ongoing debate about whether, quote unquote, the stock market is right or the bond market is right in terms of what they are pricing at these levels.
It's true. And I mean, you had talk out from the Fed officials this week. You had Dallas Fed President Lori Logan speaking out this week and saying, yes, the data shows progress, but it's too soon to tell, right?
Yeah.
About what's going to happen. And, and now we have this language of, is it going to be a skip at this meeting in June with regard to what the Fed will do next?
Yes. And we are going to hear from Fed Chair Jay Powell and former Fed Chair Ben Bernanke. They're due to speak this hour in a conversation. We don't know that we're going to get anything on the direction of rates, but we did speak with economist Joe Brusuelas of RSM in the last hour, and he talked about his expectations for where the Fed might end in this particular cycle and what we might hear from them next.
My sense is they're going to upgrade the forecast for this year, so it won't look like an inflation is imminent. Then we can have a much more nuanced discussion around the evolution of the path of monetary policy, and indeed, the Fed may need to pull back on its quantitative tightening program because after we get through the debt ceiling, Treasury's going to have to flood the market with money. And you're going to want to watch the repo market as the canary in the coal mine around some near-term disruptions once we get through the artificial political crisis that's been induced.
Yeah, to Joe's point, there is that little fly in the ointment called the debt ceiling crisis, and that also could affect how all of this is gamed out.
Yeah, well, we'll certainly be watching for what Chairman Jay Powell has to say today, along with former Fed Chair Ben Bernanke. Meantime, taming inflation has been one of the key drivers of the Fed's rate hike decisions. And while headline year-over-year inflation has been showing signs of cooling, the aging U.S. labor force highlights an inflation risk. Here to break all of this down and more is ADP Chief Economist Neela Richardson. Neela, thanks so much for joining us. Let's start with the inflation conversation and kind of your perspective on what the Fed is doing. Let's talk about even the 2% target that it's going for. Can it hit that?
It's possible, but it's going to be hard. And it's harder than it was prior to the pandemic. And here's why. So the Fed is really a short-term agent. It acts in terms of cycles. It's really trying to lower the inflation down to that 2% in the here and now. But the future of inflation is somewhat outside the perspective of monetary policy. And it really has to do with demographics. When you see the prime age workforce, that population rising, that is deflationary, according to academic research. And when you see the non-working population rising, it's inflationary. And that's exactly what we have in the United States and in most advanced economies. Very young and somewhat older are growing faster than the working age population in their prime age working years. And so that's going to put some pressure on inflation as people consume more, but produce less as a population. So those are the long-term dynamics. In the short term, it's really about whether or not the Fed can, despite these longer-term trends that pump up inflation, keep inflation moving in the right direction over the next few months.
So I got to ask you, with regards to the Fed's next meeting coming up in June, there's expectation. The demographics are changing on what, or percentages, I should say, are changing on what's expected to come out of this meeting. Will the Fed pause? Will it actually raise again? What's your expectation coming out of the June meeting?
I think it's too soon to tell to call the June meeting. I know there was discussion just now about whether the markets are right or whether the Fed is signaling something different, but the consumer is always right? And then what the consumer is saying is that, yeah, we're still spending, but we're not spending as urgently or as excitedly as we've done in the past. And so we've seen a rebound in consumer spending trends a bit in April from the slump in March, but it's clear that inflation continues to take its toll on the consumer. And so that's the watch point, right? How are interest rates affecting the consumer versus how inflation is affecting the consumer? And so in that June meeting, I think you're going to see another read on the labor markets, which has been supporting consumer spending this whole time, but also whether or not the consumer is bending to the inflationary pressure.
And so you say the consumer is always right. How would you characterize the state of the consumer right now?
The consumer's been resilient this whole time, but it hasn't stood still. At first, the consumer was spending on a lot of goods, and then it shifted to services. In this last report, we're seeing the consumer kind of back away from both of those things that were the highlight of their spending trends. They're not buying big picture, big ticket items to the same extent, automobiles and furniture, and they're not really leaning in terms of restaurants eating and consumer-facing services. So the consumer is in that selectiveness. They're looking at, the necessary items that they need, not necessarily bending in either direction. And we didn't see a big rebound in April. So consumers holding the line, that's great. It's been supported by a strong labor market, but inflation is definitely having an impact.
And I want to ask you about the labor market in particular. You've put out your thoughts on it, and you say the big quit is over, what we call the Great Resignation, and now it's time for the big stay. What do you see and what do you mean by that?
Sure. The Great Resignation, as it was known, wasn't driven by economics. It was driven by the fact that people during the pandemic kind of reevaluated their relationship to work. But it was definitely supported and fueled by the economics of the labor market. The fact that there were all these fiscal programs that were started during the pandemic to aid the consumer during this emergency time, but also supplemented by the fact that there was plentiful job openings and lots of opportunities and lots of rewards from job switching. Now we're seeing that those economic drivers and supports are starting to wane. First of all, emergency contributions to the household have ended or are ending, with the student loan deferments ending this summer. We're seeing the gains in terms of wage gains to switching ease. They're no longer commanding the same pay growth they did from switching jobs. And so with the ends of these supports and the benefits from job switching, people are now going to be incentivized to stay on the job longer.
All right, we'll have to leave it there. Our thanks to you, Neela Richardson, Chief Economist for ADP. Thank you so much.
Thank you.
Shares of Morgan Stanley under pressure, trading down about 1%. This after the bank CEO, James Gorman, says he's out with a big announcement this morning, saying he will step down from the leadership position within the year. The battle to become his replacement is on. Gorman says Morgan Stanley's board has identified 3 possible candidates for the role. There are Morgan Stanley executives Dan Simkowitz, Ted Pick, and Andy Saperstein. My colleagues Julie Hyman and Brad Smith spoke with Semaphore finance reporter Bradley Sachs earlier, and he spoke about Gorman's legacy transforming Morgan Stanley into what it is today. Let's listen.
If 20 years ago, you said Morgan Stanley, this, well-known investment bank known for, deal making, was kind of riding along with its wealth management, leading the pack, you'd be surprised. But I think that's going to be his legacy, is that he turned this bank into a very stable, dominant player in a field where it had always been a player in, but, it's become a leader.
Now, Gorman has been CEO since 2010, so 13 years in this role, making him one of the longest running U.S. bank CEOs. He plans to stay on as executive chairman for a period after the new CEO takes over. And keep in mind, under Gorman's mantle, he also brought in E-Trade. That was one of the key acquisitions he did. All right, coming up, this week's retail results painted a picture of a choosier consumer. Next week, Costco, Best Buy, and Dollar Tree step up to the plate. We'll discuss also the nation's biggest employer, Walmart, next. All right, let's do a quick check of the markets sponsored by Flex Shares. You've got the major indexes kind of range bound at the moment. Dow a little higher on the plus side by a few points there, 8 points there. S&P 500 also barely above the flat line, really kind of just sticking around that 4,200 level, just barely above it. Nasdaq under a little bit of pressure, so some choppy action. around the midday here. Meantime, the big retailers like Home Depot, Walmart, and Target all release earnings this week, missing expectations except for Walmart and raising concerns about a pullback in consumer spending. Here to discuss this and more is Brad Smith. Hey, let's get into it,
Let us. Absolutely. All right. So if there was one way to kind of try to summarize this retail portion of the earnings season, I'm going to try and throw a little alliteration on it, if you may.
Okay.
And we're going to go with shifts. We're going to go with store traffic. I threw it off with the T there, but we're also going to talk about shrink here. So first, shifts. From necessities and discretionary, if you're breaking it down or looking across some of the U.S.'s major retailers there's been a shift in where those dollars are going. You think about the discretionary categories or the other categories that a company like Walmart, who no doubt has those grocery necessities, those are week in, week out type of purchase, as well as tracking where the consumer elsewhere in the store is perhaps perusing a little bit more. And they're doing that more at Walmart than they are at Target. However, for both of them, it's still not great right now. They're still looking across the mix shifts right now and saying that consumers are being more discretionary, being more choosy about where those dollars are going in store. So you might see a little bit more of that choosiness continue to permeate in future quarters as well. There's also the store traffic trend here. And if there's one thing that you think about, it's where consumers tend to purchase and how they tend to purchase when they are looking at or hearing about a recession for as long as we've been as long as we've been talking about it. And within that, the digital part of that starts to come into play because it comes back to how they're comparison shopping. And if they are comparison shopping more, a lot of that store traffic may diminish while they're doing more comparison shopping online. That leads to more digital opportunity for Touchpoint. But where does that go towards? And for a company like Amazon, for a company like Walmart that's invested heavily into their digital sales and their online traffic, their e-commerce grew by about 27%.
Walmart did well with e-commerce.
And then lastly, on the alliteration attempt
I know you're trying to get all this out.
Shrink was one thing that continued to be talked about at Target. That was an issue there. Walmart didn't say a ton on that. We spoke to the CFO of Walmart on this and just gave us a little bit of the inclination as to where shrink is impacting this, impacting the broader retail segment. And then largely, I'm going to throw a bonus S in here. You get a bonus S on the day, and it's shoes. We got Foot Locker's results on the day.
Those were bad.
And shares are looking absolutely terrible right now. The reaction here, the wrong foot, is what it seems like the retailer is getting off on this year. But it really does come with this lace-up strategy. You're going to see more of a really stringent look across the overall retail footprints that they do have and the amount of square footage that they have to operate.
And we're still on retail detail in the week ahead with Lowe's. We'll see if they did as poorly as Home Depot. Best Buy, et cetera. All right. Thank you, Brad.
Yes, indeed.
All right. NFTs were all the rage in the last couple of years, but is the hype dying down? This month, NFT sales could fall below $1 billion for the first time this year, according to a report from DappRadar, a Web3 app distribution platform. The report attributes the change to traders selling NFT holdings for a loss to get in on the meme coin frenzy. But in Indianapolis, NFT stands are gathered at VCon 2023, a multi-day conference featuring discussions and performances with leaders in Web3, business, and pop culture. I saw Jordan Sparks on that lineup. Here to discuss the conference, consumer behaviors, and innovations like AI is the creator and host of VCon, Gary Vaynerchuk, chairman of VaynerX. All right, Gary V, as we all know you, I follow you on Twitter. Everybody follows you on Twitter. First, let's just talk about the conference. I see you have some heavy hitters in the lineup. You started yesterday. What's been the vibe like, if you will?
Look, I think the cool thing about what we're doing here and what we've been doing from day one is we're building on something I've been doing for 15 years, which is practical positivity, right? Positivity, optimism matters, but you can't be delusional, and operations matter, and the results matter, and merit matters. And I think that's the blend that we've got here. So yesterday was phenomenal. The weather was great in Indy, thank God. Thousands and thousands and thousands of people on a field day doing different events. And the lineup is just outrageous of the 130 speakers that we have at the conference over the next 2 days here in the stadium at Lucas Oil. So far, so good.
All right. I want to ask you really quickly about Twitter. As I mentioned, I follow you on Twitter. Twitter has new leadership coming in, recently announced this week. Over at the WPP, they said Twitter no longer is high risk after this new chief is appointed. What's your thought about Twitter now?
It hasn't really changed. I really didn't see Twitter as a high risk for advertisers based on consumer behavior. Obviously, some people that are writing the checks may not like or agree with things that Elon does, and then thus rendering them not wanting to advertise. But obviously, Linda comes in with as much equity in ad land as there can be. And she's been a remarkable innovator and executive in the traditional media space. And now what she's done for championing brands spending money on TV commercials, she'll be doing for Twitter. And she was highly effective in her old role. And to WPP's stance, I fully agree. There's not going to be a single brand that's going to be concerned to spend on that platform. So from that standpoint, I think it's a win. And that's how I see it.
All right. And I want to talk to you about another social media platform, TikTok. We had news out this week that Montana is applying a ban on TikTok. What does that signal to you about the status of TikTok in America?
A little bit above my pay grade, because really what we're talking about here is states or the government, the federal government, deciding that an app that is owned by a Chinese company is got so much information that's detrimental to our society. It's impossible for me to speak on that, given that I don't see what they see. What I know is that I am not overly emotional about any platform. When Vine is hot, I'm marketing there. When Facebook's hot, I'm marketing there. It's kind of like running commercials on Seinfeld. When it's the #1 TV show, you run ads. When it's not there anymore, you run it somewhere else. So attention will ebb and flow. But to answer you directly, it's just, we're talking about banning something because they're spying on us. That's a much bigger thing than marketing.
I understand, Gary. And I know you're saying it's above your pay grade, but I don't think it is, in the sense that you really have your finger on the pulse of just social media in general and connecting with people in general using a variety of platforms. And I think you've talked before about really not putting all your eggs in one basket, because think about once upon a time, MySpace was kind of the OG. Right?
Yeah, from that standpoint, the biggest issue of 3 years ago was I was yelling at people to go on TikTok, but they were cozy on Instagram, and then they regretted not doing it because they lost their relevancy. To your point, if TikTok was to be banned in America, that attention goes somewhere else. Is that going to be Instagram? I'm not so sold, because the form of content that needs to be successful, I would argue that YouTube Shorts feels extremely native. People are not paying attention to what's happening on Facebook Reels right now. A lot of marketers, especially the youngsters that are watching this, don't even have a Facebook. Meanwhile, Facebook Reels right now is one of the best underpriced attention places for the brands that are watching this show right now. So yeah, from that standpoint, I've got lots of thoughts.
All right. And it's so funny, to your point, they talked about that in their recent earnings call. Mark Zuckerberg talked about the Reels and how they're taking off, and they haven't really figured out how to monetize that aspect of the business, because it's hard to, I guess, integrate the ads within the Reels.
Well, and for everyone who's listening, especially this kind of audience, that means there's still opportunity to get organic reach. So while platforms have something explode from attention and they haven't thrown their full ad capabilities against it, what is happening there is an opportunity for your videos to get more reach. And that's something every small business and big business should be paying attention to.
All right, Gary V. We didn't get to AI today. I did want to talk to you about that.
Time.
I'll have to next time, or I have to hit you up on social media.
I'm in.
All right, thank you so much for joining us today.
Cheers. Bye-bye.
Coming up, the S&P 500 closed at August 2022 highs yesterday. Now it's above 4,200. That's the level at which Bank of America thinks you should think about hitting the sell button. So should you? We ask our strategists next. All right, time now to take a look at the latest market action. We've kind of been seeing stocks trade range bound. To help us dig into that deeper is Yahoo Finance contributor Remy Blair. She's over at the New York Stock Exchange. Remy, take it away.
Well, the major U.S. stock averages may have opened higher on Friday morning, but this does come on the heels of extended gains for the major averages in the past two sessions. As we head into the noon hour here at the New York Stock Exchange, we are seeing mostly flat trading for the Dow, Nasdaq, and S&P 500. Now, this week we had a slew of earnings reports as well as economic data, and we are digesting the latest Fed comments as we look ahead to the weekend. And in terms of market-moving stocks that we are watching today, we are looking at Foot Locker. Shares of the company open lower by a double-digit percentage point, down by about 24% after it reported dismal quarterly earnings for the fiscal first quarter and also reduced its outlook. Now, the footwear retailer missed on both its top as well as bottom lines, and the company also had to increase markdowns to drive sales in the latest quarter. And another company that we're looking at this morning is Catalent. Shares are up over 10%, and earlier there were reports that the company had received a notice from the New York Stock Exchange that it wasn't in compliance with listing requirements after delaying the release of quarterly earnings. But we're here about to head into the noon hour, and we know that Catalent did cut its full year net revenue as well as its profit forecast. And results also showed that operational challenges as well as higher than expected costs affected the company. This does come as Catalent did flag over $400 million of a hit to both its annual sales as well as core profit expectations earlier this month.
All right, Remy Blair at the New York Stock Exchange. We appreciate that report. Stocks seem undeterred of late, pushing higher despite lingering uncertainties from the Fed's June meeting to recession and the never-ending debt ceiling talks. Those are the overhangs. Then there's this debate over the health of corporate America more widely. Now, S&P 500 companies have delivered a healthy amount of beats, but accusations of corporate sandbagging or lowering expectations just to surpass them has also been a theme. So where do we go next? Joining us now has Ben Emmons. He's the senior portfolio manager and head of fixed income at New Edge Wealth. Ben, thank you so much for joining us. Let's talk about this rally. I know today we're seeing, today it's like a one-off kind of range bound given just the day of the week it is, and you have some that witching effect, if you will, coming into play today. How would you characterize where the market is? There seems to be kind of a risk-on attitude.
Yeah, on the one hand, it's about the data itself. As you mentioned, the earnings are better than expected. The retail sales are better than expected. Some of the ISM and employment data are better. The jobless claims start to turn lower again. So the market picks up that the economy hasn't lost its resilience just yet, despite all the recession fears. So that matters, I think, fundamentally. Technically, as you mentioned, there's a lot of options, exploration going on. And there's a lot of, short positioning in the market with this about fear of a recession, and other worries are out there. And that I think is kind of pushing the market a little bit higher. So this is a very key level, as you mentioned, and it could well lead to higher levels from here temporarily.
Temporarily. Okay. So what's the speed bump that changes things?
Well, as you indicated, so we have the Federal Reserve coming up. We now have Powell on a panel with Bernanke at a conference.
Right now.
Right as we speak. I was just watching the headlines, and he does say rates don't have to go as high, but they're going to go potentially higher. That's echoing what other Fed members are saying. So this is a live meeting in June, and that makes it for the market a bit of a tension point, because if this debt ceiling passes, then we're going to get focus really on how high will this rate really be. And when we visit where we came from before the banking crisis in February, maybe rates have to go as high as possible to get inflation down, and that could put pressure on the markets.
So the debt ceiling is in focus right now and has been recently. We've been here before as well. Do you think we're going to pass this hurdle?
So it looks really strong indication that all parties want to get this over with before June 1st deadline. So Yellen has done a very good job in maneuvering that, because again, she met with bank CEOs and expressing her concerns about this is a real risk at June 1st. The Treasury has a balance at the Fed that's now almost depleted. So there's an urgency on the part of the GOP and the Democrats to get at least the debt ceiling extended and then work out a further budget over the next year. To the markets, it's all about the the extension of the debt ceiling, there's no default. And then we'll have to look further how ultimately it all impacts. The Treasury probably has to replenish its balance and issue some more debt. I think actually that it ultimately is about confidence in the economy. This debt ceiling episode seems to have not so much of an effect on confidence as it did in the past, given the short time that they are seeming to get together and resolve it.
Okay, I got to ask you about recession risk. My sister called me recently. She's very smart, lawyer, et cetera, and asked me, are we going to be in a recession? So I got to ask you, I'm going to ping that question to you. We're not in a recession right now. What's the recession risk for this year or next year?
So there's always a recession around the corner. That's just the nature of the economy, right? We're in a good economy right now and things could turn quick. But there's a lot of indicators that people look at as they are signaling that there could be a recession. For example, the yield curve being inverted, or some forward-looking indicators on new orders or confidence for that matter. So it points that the Fed is putting enough pressure on the economy to try to get inflation down, but it will never be without a true soft landing, as they say. In fact, it probably will lead to some level of downturn, but the idea is that it will be a mild downturn because the Fed feels that it could raise rates to a certain level and then bring them down again next year. So this recession that we're looking after is a bit elusive in a way. The timing is really difficult, but I would say that is it in the cards? Yes, it is. But one major indicator that says it isn't is the unemployment rate and jobless claims.
Yeah.
Clearly, that says to me there's no recession, nowhere near.
Yeah, the job market has been strong even in the face of just the changing economic climate. So it just continues to remain strong. To your point, one more question I want to ask you about is just the retail sector has been in a lot of focus this week, next week, et cetera. What's your assessment about the retail sector?
So there were good results there, but there was also a lot of caution. Inflation is biting consumers. They have to buy food, so that's a big part of their budget currently. So they're moving away from other goods into food. And so apparel is one example. But then there's also a lot of digital sales that are happening. That's really the pandemic effect, I think, that has accelerated that. So by and large, the consumer is holding up, but there's still a lot of substitution effects going on. And I think at some point, if inflation stays this high, this sticky, and doesn't really go down, then yes, the retail sector will start to really decline in activity. So far, it's holding up relatively well, and I think part of it is too that we're still in a reopening sort of phase, maybe the very last phase of it, because a lot of it is leisure activity that's driving part of the retail momentum currently. So I say again, that's another signal of the retail earnings show there is really no recession. There's no retail recession, but it is a sector that's very vulnerable. I mean, that is the last bastion, because the manufacturing sector has already shown significant slowdown.
Yeah, you make excellent points there. I mean, people are still, they have to buy their necessities. So Walmart is going to be strong because they dominate in grocery. Whereas you do see some challenges we saw challenges with Home Depot. Target did beat, but they pointed some challenges that they're having. So, excellent points there. We will have to put a bookmark in our conversation. And I look forward to our next one.
Thank you. Thank you for having us.
All right. Our thanks to Ben Emmons, Senior Portfolio Manager and Head of Fixed Income at New Edge Wealth. Coming up, Montana's governor is doing a victory lap after banning TikTok, but it may be short-lived. We've got the details. That's next. Montana has become the first state in the U.S. to ban TikTok, but the victory lap for Montana Governor Greg Gianforte may be short-lived. Yahoo Finance's Dan Hawley joins us with the details. Dan?
That's right. This new law, which goes into effect January 1st, 2024, would effectively prevent Google or Apple or any app store provider from allowing users to download TikTok within the state of Montana. Now, there's a few issues here, both one First Amendment, one technical. Let me start with the First Amendment issues. Experts that I spoke to basically said that blocking the app entirely would violate Montanans' First Amendment rights to free speech. And essentially they say that that's because they're seeking a broad means without trying to first go ahead and provide a narrower means of attacking this problem that they say exists. The idea that China is siphoning American user data from TikTok. Now, the experts that I spoke to said that a more clear response than just banning TikTok outright would be to set up some kind of national privacy data legislation. So that's something that would be narrower. It wouldn't include banning an app that 150 million Americans use, and it would still allow Google and Apple to provide the app. It would just limit the means for apps, including TikTok rivals like Meta and Twitter, from collecting user data. Now, that's the First Amendment side of things. Then there's the technical side of things. Basically, this is something that banning an app in an entire state, but a specific state, is difficult to do. Now, they could say, okay, your IP address, your Internet Protocol address, which is basically your address for when you're online telling where you are, could be used as a means for kind of geolocation or, your GPS signal. But the problem is that if you're near the border, for instance, of Montana, other states, residents in other states could be impacted. So they wouldn't be able to download TikTok as well. The other issue is people could just set up a VPN and then say that they're in, Venezuela and download TikTok within Montana. So there's no surefire way of this actually seeming to work. The other problem is Apple and Google would be on the hook. It would be $10,000 per violation. So anytime a person downloads TikTok, once this goes into effect, Apple and Google would have to pay $10,000, and then an additional $10,000 for each day the violation continues. So they could rack up millions of dollars in fines here because of the app itself. Now, overall, it doesn't seem like this is going to hold water under scrutiny. There's already a lawsuit being filed by some residents in Montana who are seeking to nullify this law. It really does seem as though it's going to be something that falls to the wayside rather quickly if it's challenged in courts. At least that's according to these First Amendment experts that I spoke to.
All right. Well, we will have to see. Dan Howley, thanks so much. Meanwhile, the World Health Organization is out with a new recommendation for fall COVID-19 booster shots, saying the vaccinations should focus on one variant in particular. Yahoo Finance's Anjali Khemlani joins us now with the details.
That's right, Dan. So the World Health Organization did let us know yesterday that their recommendation for fall boosters should include the XBB variant. That's the one that's most dominant now around the globe as well as in the country. But let's take a look really quickly at why the World Health Organization is recommending this. First of all, because of the dominance of the variant, as well as its ability to be immune evasive, particularly the XBB.1.5, and that is the most dominant, especially here in the United States. The current vaccines do protect against severe disease and death, so they are saying that there's still some level of protection to be offered. However, especially for the most vulnerable populations, which is likely what we're going to be looking at here in the U.S., they do need an upgrade on the variants, that the vaccines do target. So that's where things are right now on that front. The XBB lineage, notably XBB.1.5 and 1.16, are the two most dominant variants of interest for the World Health Organization. So if you think about it as a 3-level alert system, it would be sort of second tier. XBB.1.9 also on the list that they are watching right now. And in the US, we are seeing XBB.1.5 as well as XBB.1.16. There you see on your screen 64% of cases sequenced in the United States currently circulating of XBB.1.5. So definitely a point of interest and concern for us here in the United United States. And it's important to note that the World Health Organization did say that the descendants of the XBB, quote, including XBB.1.5 and 1.16, are highly immune evasive, with XBB.1.5 being one of the variants with the greatest magnitude of immune escape from neutralizing antibodies. So that also brings up the conversation of neutralizing antibody titers being the bar for protection versus cell immunity or other levels of immunity. We have no way of really testing that, so that still remains the focus right now. So as of that, based on that bar, that's where they're looking for that protection.
All right, another variant to keep tabs on.
Absolutely.
That's right. All right, thank you so much, Anj. Coming up, risk off. Markets take a turn as debt ceiling negotiations hit a roadblock. Reports suggest GOP negotiators walked out of a meeting. We're on top of that. That's next. We have breaking news. Jet talks reportedly hitting a wall. GOP leaders walking out of the negotiations. That's according to CNBC. Markets are taking a turn lower, reversing earlier gains on the news. You're looking at all three major averages under pressure. Yahoo Finance's Jennifer Schonberg has the story. Jen?
Hey there, Diane. That's right. We're just getting word right now through reports that negotiators walked out of the room where the debt ceiling talks have been ongoing. White House and House Republicans negotiators have been trying to resolve an impasse, but those talks have been broken off, and there are no immediate plans right now to resume those talks. House Speaker Kevin McCarthy's top negotiators saying that the latest conversations have yielded no progress. Diane?
Jen, I want to switch gears also. One other thing we're watching today, Fed Chair Jerome Powell, former Fed Chair Ben Bernanke taking part in a research conference this morning, with comments ranging from inflation to financial stability. What are you hearing?
Hey there, Dan. Yeah, that conversation ongoing right now. Fed Chair Powell speaking at a conference here in Washington, D.C., saying that inflation remains well above the Fed's 2% target. It is the Fed's job to bring that down. But he noted that the failures from the banks are contributing to tightening credit conditions, which is likely to weigh on economic growth and inflation. He says that rates as a result may not need to rise as much as otherwise have been the case, though he says the extent of that remains uncertain. Take a listen.
While the financial stability tools help to calm conditions in the banking sector, developments there, on the other hand, are contributing to tighter credit conditions and are likely to weigh on economic growth, hiring, and inflation. So as a result, our policy rate may not need to rise as much as it would have otherwise to achieve our goals. Of course, the extent of that is highly uncertain.
Now, Powell did say that rates are in, quote, restrictive territory right now, and that the Fed faces uncertainty about the lag effect of the interest rates that have already been implemented and the impact of the extent on the economy in conjunction with tightening credit conditions as a result of those bank failures. Now, Powell did say that he thinks slack in the job market is contributing to inflation, particularly inflation in that so-called non-housing services sector. He says that's showing signs of real persistence. Labor costs are a large contributor there, and that is why it is remaining so sticky and difficult to bring down inflation. Diane?
All right, Jen, thank you so much. Again, debt talks reportedly stalling. GOP negotiators walking out of talks. That's according to NBC. This as the deadline for a deal, the dreaded X date, fast approaches. Now, we've been here many times before. Since 1960, the debt limit has been raised over 70 times. Though after decades of the same old story, could it be time to bring the debt ceiling into the modern age and make a change? Joining us now is Steve Clements, Semaphore founding editor at large. So, Steve, first, let's get right into what happened today. First of all, this was surprising when I saw the headline come across.
We're right on the edge of news.
Again.
Yeah.
We've been here before. I remember going through this more than a decade ago. So what was your initial reaction?
Well, look, I mean, those who've been around these debt ceiling debates in the past are all saying this is a ritual. It looks like it's going to go to the brink. And everybody who's very calm-handed said, don't worry, it will all be okay. There's just something fundamentally different about this moment. I don't know how it's going to come out in the end, but you actually have Kevin McCarthy, the Speaker of the House, with a very slim vote margin in his own caucus to continue to pass and support whatever deal he comes out with. And those members have been very, very tough on exactly this issue. And even some of them have welcomed a default as a way to really punish government and to kind of bring spending back in line in the way they'd like to do it. So that makes the tension over all of this greater. The other element of it, if I may, is that Joe Biden left town. He went to the G7 meeting. And when he left, he says, all four of the big four plus myself have all committed against default. I've actually never heard Kevin McCarthy say that. The president said he said that. Kevin McCarthy wants his plan. He wants his stuff and to get that done. But there were a lot of Democrats saying the president should not leave the field of battle with Kevin McCarthy. And it shows that the White House is potentially minimizing a very, very key negotiation and debate by running to Hiroshima, Japan. G7 is obviously very important. I get that. But a lot of Democrats were grousing about it. And now at this crisis that you and I are hearing about for the first time, Joe Biden's not here.
Okay, yes, to your point that he's not here, but he did cut his trip short. What does that signal to you about, just potential for a deal before June 1st?
Well, look, right now, I think both sides are expecting that one way or another, they're going to find some deal. And the deal that we know is some clawback of funds, some freezing at 2022 levels of appropriations, some bringing back of COVID relief funds. But then the big issue that I think is the most hot between them, and I don't know what the standstill was caused by, but I suspect it had to do something with worker requirements and age requirements related to federal government assistance across a number of programs, which has been a red line for Kevin McCarthy and his negotiating team. And the White House indicated it could be flexible in some of those areas. So we don't know what has come undone in that, but that's likely one of the areas where the deal-making, the likely deal-making is. Remember, when President Biden left, the market surged because it looked like we were getting closer to a likely deal. I think both sides now are waiting, okay, who's going to blink first in this, and what are the markets going to say?
To your point, yeah, I found that to be a sticking point as well. And yes, the market has reversed course now following this news. NBC correspondent saying that Representative Graves suggesting that he thinks that the White House team is being unreasonable. And you also said that there seems like there's something different this time around. What stands out to you as what is different this time around?
Well, I think what is fundamentally different is that in the past, even though, remember, President Biden voted against a debt ceiling increase once when he was in the Senate, people have played around with this, but not in any way that anyone would seriously sabotage and undermine the full faith and credit of the United States. And I think that is at risk right now because you have a number of Freedom Caucus members in the GOP caucus that brought Kevin McCarthy his speakership. And they said, look, we're not going to walk away from this. We're going to remain hardline. And as Kevin McCarthy and Joe Biden got closer and closer together, the complaints we heard is that the more and more likely we would got a deal, the more and more worried that both progressives and the Freedom Caucus had that the deal making and the compromise was somehow going to undermine their core interests and they could fall off that. So you've got a situation where a good deal, bringing the nation together, bringing these forces together, getting something done by June 1st may be hard for Kevin McCarthy to do because of his flank, but also that's true for the White House with its progressive members.
And to your point about the credit of the U.S., you'll recall before, our credit was dinged and it was dramatic. It was unprecedented when we went through this round before. What do you think what's happening today and, with them walking away from the table, what could this do to the credit rating of the U.S.?
Well, I don't know how the credit rating, folks are going to look at this moment and whether they can see through the gamesmanship of this or not. But fundamentally, when you shake the notion that America might ever really default on paying its bills, that increases risk. The rating agencies are going to increase that risk, and they're going to do it as a way to send a signal, about this essentially what many of us look like is craziness. And remember, when you saw that rating, that interest rate increase, which we had was across the board, big, substantial, tectonic interest rate increase, that gut punches the American middle class. That gut punches American small business and everybody who's out working. It creates tidal wave effects for both people and businesses out there that are substantial. And it right now, when you're in kind of trying to work our way out of inflation, trying to figure out, how to get out of a recessionary feeling like moment. This is not helpful. This is a political crisis created by politicians, not by the demands of economics. And, it's raises one other thing that, a lot of Democrats have been saying is, why doesn't Joe Biden be bold, pull out Article 14 of the Constitution that says very clearly the public debt will not be questioned, and use that. Now they say, well, it'll go to courts, it'll spend, but at the same time, people are looking for boldness at this moment, not weakness. And the constitutional track may in fact derail this kind of future insanity.
All right, Steve, we're going to have to put a pin in our conversation and clearly come back to this. Steve Clements, Semaphore founding editor at large. Our thanks to you. Quickly, let's check some individual tickers. Shares of Foot Locker nosediving after reporting a big miss on earnings. The athletic retailer says net income totaled $36 million, 38 cents a share, down from $132 million a year ago. Sales fell below $1 billion, and the company slashed its guidance off the back of those lackluster results. Nike also taking a hit today, though not as dramatic. That stock down nearly 4%, following a report in The Guardian that the company could be hit with $500 million in fines over misclassifying thousands of temporary workers. And that'll do it for me. Have a great weekend.